I want to finish up operational risk. You did some Doug Hubbard. Hopefully you see why I like him so much. Interesting guy. I do highly recommend his books. He he's a bit expensive. I did do his calibration exercise. I'm I think I could recreate the whole thing. I don't know if I would be violating some patent or something if I did it. It is very interesting to go through it. It's a little expensive, but it was interesting to go through, and it is my eye-opening how bad we are at estimating. It shows you how he got his charts because it will have people calibrate, say, it's very, he just asks a series of questions and he tells you to give the range, that's your 90% range. And if you're right 100% of the time, I mean, if like he says, what year was Mozart born? And you say, oh, somewhere between 1000 BC and 2025, you're going to be right 100% of the time, but that's still wrong, right? Because if it's a 90%, you should be right 90% of the time, you should be wrong 10% of the time. Most people, when they do their 90% range, they're right about 60% of the time, not 90% of the time, their ranges. But after you do the exercise over and over again, you start getting better, getting to the 90. How much of that sticks 6 months later or a year later, who knows? But it's a very, very interesting exercise. But I could easily recreate that. You start when you get into the exercise. One of the things you do, which I think probably skews it, is instead of trying to do calibration, you're trying to prove how smart you are. And so then you're like, oh, Mozart, yeah, he had been born. You're trying to guess. I'd probably do better at it than the average person because I have a music degree, but I can't remember exactly what year he was born in, but I would know it'd be the 18th century. Some people might think I was listening to, those interviews on the street. What year was the United States founded? Oh, 1940. It's like, so, we would do better. So you're almost embarrassed for your answers to be out there. So, you kind of want to make look, but the key is your calibration. How good are you at calibrating? And we are consistently much further in than we should be. We're not very good at that. So here's some quotes related to operational risk. A lot of them coming from Hubbard. We leave something out because it is uncertain. The whole point of doing risk management is to bring uncertainty in. So say, "Oh, I can't forecast that, it's too uncertain." Well, then that's a risk and you need to spend some time on that. So it doesn't make any sense. It's almost like not drinking because you're too thirsty. That comes out of the failure of risk management. Some address this pre-mortem analysis. We'll talk about pre-mortem with Annie Duke. I like the idea of pre-mortem. I don't know if y'all know what a pre-mortem is. If you ever heard that term before, you've heard of post-mortem. What is pre-mortem? So we'll talk about, Annie Duke talks about that. You're making a decision and you're ready to go. Before you make it, you say, okay, let's assume we made this decision and 2 years from now it's a disaster. Tell me what happened. And you get your mind thinking on the pessimistic side because we're too optimistic and things start coming up you can think about before. We'll get into that. Another approach is prediction markets. We're looking at that. I don't know what they're doing today after what happened today. At the end of the day, given we're all over the place today with the news, but prediction markets are really quite good, especially if there's money involved. So if someone was at Valero's trying to forecast the crack spread, the best thing you do is have all the employees bet money and you get a much better forecast than if you had one person do it. It's amazing how the crowds are better, especially if there's money, skin in the game. So that the average of experts, when there's money on the line, is more accurate. I don't know if Valero can do gambling on the site, but that would be interesting. Another thing is how you prioritize things. I love Longbarg's site. It's really, really quite interesting. He talks about what are those projects we should do. And why is he talking about that? Well, because he's using data to say what is most reliable, what can we actually have some confidence in. He said there's a lot of that. He makes fun of some of these World Health Organizations and some of the data they have that is so wishy-washy, non-measurable. No way they ever can get it. It's like in 5 years, we want everybody to be happier. It's like, how do you even measure that? What is it? So Why is that so important? Well, because we're terribly optimistic. So I don't know how many of y'all follow the California high-speed train. Any of y'all follow that? $10 billion project can connect LA to San Francisco. Where is it today? Anybody know? There's no track yet. Zero. But where's the cost up to? It's not 10 billion anymore. Anyone can guess? It's over what? So they haven't done anything yet, and it's over $100 billion. They're now saying, well, we'll just do it from LA to Bakersfield. Bakersfield. You could probably have everybody in Bakersfield go to LA and back every day, and you still not have enough passengers. So how can a project fail that horribly badly? And that's actually pretty common. So there's a book I do recommend. I like it. I got a lot out of it. It's How Big Things Get Done. He's talking about these big projects. If you work on the corporate side, these big projects, you have to think, how long does it take? I remember with me with doing swap contracts. You think it's going to take you a month or two, and it takes 9 months. I remember Barclays Bank. I call them, oh, we're really good at it. We'll have it by the end of the month. And 9 months later, my lawyers say, we can't deal with this bank. They're too hard to deal with. So things just take a whole lot longer. Um, so this is a good book. I don't like his last chapter because he has a little bit of a political spin at the end, but still, why are solar panel projects so much better than other projects? Because they're you have pieces that you put together and it's, one piece after the other. He gives the example of Empire State Building. Empire State Building came in under budget on time. How did they do it? Because every floor is practically identical. So as they went up each floor, they got better and better and better. Why is the California uh, high-speed rail such a disaster? Well, China does them much faster, much cheaper. They could have hired someone with that experience, but they didn't. They hired US firms that had zero experience. What happens when you have a massive project and you hire people who've never done it before? It's pretty disastrous. Does that make sense? No, but that's the political side of this. So he brings that up is you need people who have experience and you need it to be repeatable. That's why solar panels work so well. It's the same project over and over and over again. Nuclear power plants are really tough to do because each one's different. Why is France so good at nuclear power? Because every one of their plants looks exactly the same. They just keep rebuilding the same thing over and over again. So he gives you those secrets on how these big projects can actually come in on budget. So it's a good book. Projects is a big part of what we do in finance, and we're really bad at them. So it's good to say what will make you successful. This guy says the best book of the year. I don't know if that's particularly true, but it was an interesting, good book. All right, let's talk about inflation risk. I think inflation risk is one of the most difficult ones. Historically, we talked about TIPS, inflation-linked bonds. We've talked about gold. Those two failed in 2022. Gold is failing right now with inflation being elevated. I want to do an analysis that maybe oil prices, energy prices are the best hedge for inflation because I cannot think of an inflationary period where energy prices weren't really high, but I don't know for sure. But purchasing power risk is one of the most difficult ones to manage. Do you hedge it or you just accept it's going to happen? So if we repeat the 1970s when we had double-digit inflation, that was a pretty horrible time in the US. It was it wasn't like people were, dying in the streets or anything, but it was pretty laissez. Just pretty just kind of boring times. No one was really excited. And we finally got that fixed. It's really, really tough. I will say on tips, inflation-linked bonds, the tip yield right now is at a reasonable level that it really, I think, will protect you from inflation. You have to be careful from tips because they sell off when real rates rise. Real rates have been rising this year, but you are getting tip yields that are fairly decent. So as I say, if tip yields go to 3%, I will be buying tips. To me, to get a risk-free 3% plus inflation as a retired person, that's a pretty good protection. And real yields rarely get above 3%. And it's hard for me to think of a scenario where real yields would shoot up above 3%. There's no logical reason. So Tips might be back as the protection. Catastrophe bonds is another bond I think is interesting, um, because it's floating rate and it gives you a high yield because it's related to catastrophes. But then if you have a major hurricane, that's obviously going to hurt you. But it's tough. So it's the risk of loss because inflation eats into your real returns. You can do value at risk analysis. When I was at USAA, we bought our first stochastic model, and I had it on my desk. It's like, now what I do with it? That model ended up saving us like $3 billion in 2008, so it paid for itself. But at the beginning, it's like, okay, I got them to spend a few hundred thousand on this thing, and they came to me with a project related to inflation. It was a product being sold by AIG. So I set it up, did the analysis. I ran a Monte Carlo. I had to do serial correlation. Y'all know what serial correlation is? I asked my dashboard team. So serial correlation is something that's related to itself over time. Inflation is not this random thing. Interest rates aren't 10%, then 2%, then 11%. They kind of move in a pattern. So today's inflation has about a 0.6 correlation to inflation 2 or 3 years ago. There's this, so I had to build in serial correlation, had to bring in standard deviation. And so AIG was thinking this is USAA, a bunch of country hicks in San Antonio. They'll never figure it out. And then we figured it out and they were kind of shocked. The guy, I go to Valero and I go, you're charging 100 basis points and there's no way this is worth more than 10. And he goes, yeah, you're right. I go, yeah, why are you trying to rip us off? But it was interesting, but I could not have done that without this type of model. So value risk works really, really well. But if you do inflation type of value analysis, you can't just set up a random, inflation interest rates have to be correlated to themselves over time. You can't make 6 month inflation 6 months from now completely unrelated to inflation today. So that creates some noise, but it was easy to set that up in the model. And then you model your income, your expenses, your assets, your liabilities. You try to figure out what that's going to be. There's obviously going to be some noise in there. Do stocks always fall when inflation rises? Do bonds always fall when inflation rises? Does gold always fall or rise? So you have to look back at the history and figure that out. But you essentially recreate your business under different inflation environments. How do you mitigate it? Again, gold. Gold is not so much an inflation hedge as it is a dollar or real rate hedge. So gold does well when the dollar is weak and when real rates fall. So that's why gold didn't do well in 2022 when real rates rose so dramatically. But if real rates are high and you're worried about inflation, gold would be a great place to be. Tips, if you're worried about inflation and real rates are high, tips are a great place to be. So there are some good hedges, I think, for inflation if your starting point is good. But if your starting point is not good, then you don't want to do that. Commodities, that's the one I was interested in. Oil, I think, is the best one. I'm not so sure about timber. I haven't looked at timber. Timber is an asset class. It's an interesting asset class, as I tell my investment class. I'm hoping one of my students will go finance in timber. It's a really big field. Do y'all think of timber as an asset class? It's a pretty cool asset class. So if I were doing timber, I like being outside. I would probably go to A&M and get a forestry degree, get an undergraduate in finance, get a forestry degree, get my CFA, and then go work for Hancock or one of the big timber companies. I'd be set for life. I'd be spending 90% of my time in shorts and blue jeans, and then every once in a while I have to wear a suit to go visit with the client. But does timber protect you from inflation? That's a tough one to say. I'm not really sure. I'm not sure about other commodities. It's hard to say, steel or agriculture or those other things. So I think oil is probably your best bet there. What's the problem with real estate protecting you from inflation? Well, real estate investment trusts have high yields, right? They're high yielding stocks because of the tax law. So they're quasi bonds. So when inflation's up, interest rates are up, REITs are actually going to sell off. So that's not a good hedge. What about real estate itself? What does real estate itself not like? It doesn't like high mortgage rates. What do mortgage rates do with inflation? They go up. So I'm not so sure real estate is the best protector, but you could model it. What's the problem modeling real estate? It's easy to model REITs, right? You can get REIT returns on a monthly basis pretty simply. But what about actual equity real estate? There's not good data. Real estate doesn't trade every day. You don't have daily prices. So there's a lot of noise there. It's really, really tough. So cash and short term, yeah, they're good inflation hedges, but do you really want to hold 10, 20, 30% of your portfolio in cash in short-term bonds, especially when interest rates are essentially at 0% there for a couple of years. So that may not work. So tips work if the beginning yield is strong. So what's a good beginning yield? Anything above 2 would be good. Below 2, I would be a little bit leery of tips, but they're pretty good. Real return funds, boy, they failed. Y'all know what these are. So they're usually like PIMCO has one. I don't know if I can find it. PIMCO is one of my favorite firms. I think we looked at this before, didn't we? PRRX. I don't know what this is, so I can't get into their site. But so a real return fund gives you a floating rate plus a spread. So they say we're going to beat T-bills, give you T-bills plus 4%. Whatever T-bills are plus 4%, but they have not done very well at producing that. So I'm not sure I would go with that. Can you do derivatives? Are there inflation swaps? What would an inflation swap be? You pay SOFR and they pay you CPI, or you pay some fixed rate and they pay you CPI. That'd be nice, right? The problem is there's not enough depth to that market. When we saw that at USAA, we're like, wow, this is pretty cool. CPI swaps. How much market is there? Oh, there's like 10 million. It's like, yeah, we need like 5 billion. So there's just not enough. It's not a big enough market. The problem with derivatives is a great book on derivatives that I wish I could find. I forgot the title of it. I would put it on my reading list. But as a guy who was in the market for creating new derivative securities, new swaps, new options, new futures, and it's really interesting when could you create a derivative actually work? And his argument for why CPI swaps haven't worked is there's a lot of people that are worried about inflation rising, but there are not enough people worried about inflation falling. And he couldn't find, you can't have speculators on both sides. You need hedgers on both sides. Who worries about inflation falling? He said, well, maybe the government, because they get more revenue, they get more tax, but there's not a good other side to this. Most people want to protect themselves from inflation, not protect themselves from deflation. So just not good there. Currencies, we saw in 2022, we had inflation, and what did the US dollar do? It went up. Why? Because inflation was the entire globe. Real rates went up in the United States, the US dollar strengthened. So we have people have argued that that's kind of what that presentation I showed you on environments, essentially his argument. If you have inflation, the US dollar is going to weaken, and so you want these foreign assets, but that didn't work in 2022. You can hire a currency overlay manager. We'll talk about currencies here next. I'll probably have nightmares tonight because I hate currencies. But a currency overlay manager is you give them a stock portfolio or bond portfolio, and you just invest based on what those markets are. So if you're 20% in Japan, then you're 20% the yen. If you're 10% in Europe, you're 10% the euro. The overlay manager then goes in and manages just the currency piece. How good are they at that? Who knows? Hopefully they know what they're doing. But that's not particularly going to protect you. It is generally true that if the US dollar is weakening, that inflation could be a concern, but that hasn't worked well. So you can see inflation is a tough one. So today you do have tips, and today you probably do have gold. My fear with gold is that it's up so much. Even though real rates are up, gold is up so much, it may be just overpriced. And who really, really knows? What don't I have on the list? Bitcoin. Is Bitcoin going to protect you from inflation? If you ran the scenario, what do you think the correlation would be? I would guess 0, right? So I don't think that's going to work. And y'all think of anything else that's going to help you with inflation? It's not much. And even if gold, even if oil works, are you really going to put 10, 20% of your portfolio in the oil? That looks really great until, 2020 when oil goes negative. It's like it's tough. Inflation, one's the toughest things. What does our industry do? We just assume it won't be a problem and we ignore it. Well, don't worry. Y'all saw that with Machiel, right? So, hey, bonds and stocks have a negative correlation again. What is he saying? Hey, look, we don't have to worry about inflation ever again. So that's a strategy, right? Hope is a strategy. So we do that a lot in finance. Let's just assume it never happens again. Oh, well, that solves everything. So there you go. You got it fixed. So think about this when you're managing money. If you're working for some of these investment firms, these advisors, I think you're going to notice many of them just assume inflation will not be an issue on their asset allocation side because you will not find anything in their portfolio that will do well if inflation really takes off like it did in the 70s. I will say real estate did do well in the 70s in the US. Gold did well in the 70s in the US. So there were a few things that did somewhat well, but real estate probably did well in the 70s because of the baby boomers. They were all buying houses. They were all at the age of needing real estate. So, some of that was, we're probably not going to repeat that again. So it's hard to say. So I almost think this is probably the most difficult of all the risks we're looking at, probably the most difficult risk to manage. All right, my least favorite risk. Oh, I hate currency risk. I should have brought my sweater. I bought a sweater in Germany back when the Deutschmark. I was just cold. We're at Neuschwanstein, whatever that castle is, and it was really, really cold. So I get this sweater and do the math and say it's like $100. Hey, I can afford that. That sounds good. I'm really cold. And I get home and discovered I should have multiplied when I was dividing. So it was more like $500, which in today's dollars is like $1,000 sweater. I wasn't that cold, but I did the math wrong. So I do not like currencies. I get confused. Partly they quote them differently. Like they quote the yen at 100 and something, not at 0.004. They quote the pound upside down. So I have to stop and think. If I'm going to buy something overseas, I have to stop and think. I've gotten pretty good in Costa Rica because in Costa Rica it's the 500 to 1. And I love in Costa Rica, I don't know if they do this in other Latin American countries, but 11,000 is not 1111 comma 000. It's 1111.000. So it looks like $11. So you just double everything. 11,000 colones is $22. So I've gotten pretty good in Costa Rica of doing that. But I don't like currencies. So what happens at USAA? They have this line on the balance sheet and their surplus. It's itty bitty, but one month it went negative for like 500 and something thousand. So they got rounded to negative $1 million, and the CEO went crazy. He's like, "What is that? Why are we losing money here?" It was our currency account. And so that obviously gets dumped in my inbox because no one else wants to touch it. I was like, yeah, give it to Ron. And it's like, y'all know how bad I am at currencies. So they told me to hedge the currencies. So this was our European operation. We collected premiums from US soldiers in dollars and we paid claims in dollars, pounds, and euros. And that was the currency risk. So I had to take our balance sheet. I had already moved the portfolio to Europe. So USA was managing our European portfolio, and they came to me and said, they open up like 7 hours before we do. We don't want to be here. We don't want to manage this portfolio. So I recommended let's just hire a manager in the UK. So we had a good manager in the UK to manage the portfolio. I just needed to tell them which currencies to buy. I looked at the liabilities. I did all kinds of analysis. So we hedged it, I thought, pretty well. Even though I'm really horrible at it, it's in Excel, so I made it foolproof and made sure I had to do it. The challenge I had was I wanted to hedge our currency risk back to the dollar, but UK regulations said you have to hedge it to the pound. So I want to hedge to the dollar, and by law, I have to hedge it to the pound. I won't tell you what I did since we're on recordings here, but I got it to technically work. So I was meeting both requirements at the same time without really meeting both of them. But anyway, I got it to work. The problem is, what did I hedge? I hedged the economics of our risk, but the accounting is completely different. It is almost impossible to hedge the accounting. Have y'all seen currency accounting? Have y'all done that in your classes? It's absolutely ridiculous. And no one at USA, none of the accountants knew how to do it. There was something in the system that did it for them, and they didn't even know what it was doing because no one wanted to learn it. No one was had the time to learn it. So I still had this problem that that one line was there, and it could go negative even though we were hedged. It was really frustrating. My recommendation is just move that to other and get it out of its own line so he doesn't. I mean, we got, you have $20 billion in net worth, and he's worried about a $1 million loss. It's like, it's pretty immaterial. So anyway, we hedged it as best we could. I tried to explain to him as that it's hedged. Trust me, it's hedged, but the accounting may not reflect it. And then it got worse. So that's fine. You're hedging USA's risk, but what about the members' risk? So my next assignment is hedge the members' risk because if the dollar weakens, we raise their premiums. And he said, I don't like that. Geico did the same thing. So he said, hedge that. How do you hedge that? I could do futures, right? What's the problem with that? What happens when the dollar strengthens? Now you got to, you can't cut their premiums when Geico is cutting their premiums, right? The dollar strengthens, Geico gets to cut their premiums 10, 20%. But if dollar weakens, then we win. So I had to have a one-sided bet. I had to have something that worked when the dollar weakened, but didn't hurt us when the dollar strengthened. So I looked at options and I priced out options. And if we had done options to manage that risk, it would have wiped out our entire net income from Europe. So if that doesn't make sense. So just to give you the politics of USAA, I get called by somebody, it might have been Butch Facilio or somebody saying, Ron, don't worry about it. We discovered that the US military pays a currency adjustment. So when the dollar weakens, they actually pay soldiers more money. So don't worry. It's like, great. I don't have to worry with that. Problem solved, right? Well, a year later, they had a new CEO of the PNC company. He was really struggling. So he decided to get some brownie points by throwing me under the bus. Said, you told Ron to fix that risk and he never did anything about it. He just ignored it. And so I got in all kinds of trouble. And it's like, so it was very painful. One of my worst days at USAA. I thought I was gone for very, very, very frustrating. I never got a chance to sit down with the CEO and explain. So we're in an exec council meeting. Everybody's yelling what to do. They're all telling us what to do on currencies with people who knew currencies less than I did. So it was very, very frustrating. You'll find this in your career where it's just, just let me tell you what's going on. Finally, the CEO said, I'm just going to sit down with Ron and figure this out. I'm like, yeah, everybody just shut up. I didn't say that out loud, but I almost did. And that's what I wanted. It's like, it was such a stupid conversation. People were saying stuff that was mathematically impossible. It's like, yeah, that doesn't exist. You can't do that. And then the strangest thing was I sat down with them. I explained what we had done. The strange thing was even stranger, just really politics, was Butch Facilito, who was the second ranked person at USA. He calls me to his office and he said, did so-and-so tell the CEO this? And I said, yeah, they did. And he knew that wasn't true. And he said, thank you, go back to your desk. And go, okay, what does that mean? So I think he got me out of trouble, but I'm the one that told Ron not to work on this. Anyway, that's just all the politics. You talk about risk. Where does that risk fall? That's career risk. How do you manage that? Sometimes you're just lucky, right? Butch Cecilia was one of my favorite people at USAA. Incredible man. He passed away just a couple of months ago. Very sad, but it's just incredible man. If you saw him, the first thing you would have thought of is, I bet he's a general in the military because he looked like a general in the military. Really brilliant guy. But he got me out of that. I got to sit down with Bob Davis and I told him, this is why we cannot hedge the membership side. And probably the strangest thing anyone's ever said to me at the end of that, he says, okay, Ron, you did exactly everything right. Just make sure this doesn't happen again. I go, thank you very much. I didn't know, y'all know what that means? I haven't figured that out. I still don't know what that means. But anyway, maybe you meant make sure the communication doesn't break down or whatever, but I didn't know. I was just told don't work on it anymore. So I'm going to have nightmares about currency risks tonight. I haven't dreamed a nightmare about Bob Davis in a while, but I probably tonight will. So I hate it. But with all that said, it is a pretty easy risk to manage because there's plenty of swaps, there's plenty of futures out there that handles this pretty well. Value at risk is the way to manage it. I mean, measure it, pretty straightforward. A lot of data on currencies going back years and years and years. I'm not so sure about the Colones in Costa Rica because I'm not sure there is a futures market for Colones. I'm not sure I could really hedge that. I could hold Colones. I'm now a property owner in Costa Rica. I have an Airbnb down there. Um, we'll see how it does. I'm expecting it to lose a lot of money, but anyway, so I could just hold Colones. The problem is that they shut Colones down every few years and they're not worth anything anymore. They print a new one. So that's kind of dangerous. So I don't know if I can actually hedge that risk, but I do have risk to the currency in Costa Rica. It's actually been strengthening here lately. But value risk, I could probably get data on Costa Rica and run it to see what my actual risk is when those revenues get converted back. Um, but so pretty easy to measure. Value at risk is a good measure on that. And mitigation, pretty straightforward. It's pretty easy to mitigate the economics of it. It's really hard to mitigate the accounting. So you may have it mitigated, everything looks great, but the accounting still shows a loss. So what does accounting do? They convert revenues based on an average rate for the year, expenses for an average rate in the year. They convert assets and liabilities at a point in time. And they have these translation rules that are just so bizarre. I can't even explain it. What FASB is that? FASB 830? No, y'all see a FASB? I see that 830. Yeah, that seems like too high of a number. Governs how companies account for foreign currency from choosing a functional currency to translating financials and managing exposure in volatile economics. Um, so what happened is with USAA, our currency was the dollar, but we had a functional currency in Europe, which was the pound, and then we also did business in Germany, which was the euro. Don't ask me how the accounting works. I could never have figured it out. And you can see why no one at USA was going to help me. You as an accountant, you want to figure all that out? It's like, no, sorry, you're on your own run. No one had a clue how the accounting was done. It was just done magically in the system. So I think practically impossible to manage the accounting. So what do you have to do? You need to tell people up front, hey, we're going to manage the economics of this. Trust us that it's right. The accounting may show losses. You're just going to have to accept that this is the way it is. Um, are there firms that have currency risks that aren't not hedging them, aren't taking care of them? Maybe so. I think the scariest thing I've seen, and I don't know if I can see an article on this, Japan life insurers and US dollar exposure. That to me is kind of the scariest one. So Japanese life insurance companies are holding this US securities without any hedging. So if the yen strengthens, they're in a lot of trouble. So the yen hedge gamble, how Japanese insurers risk shift is shaking. Um, it's pretty frightening. Why are they doing that? I don't know. It's bizarre to me. I should probably do a paper on that, do some research on that because it's pretty shocking. You know, life insurers are usually some of the best risk managers out there. Why would they, does it, you know, are they just thinking the yen's going to keep weakening over and over and over again? You know, with Japanese interest rates coming up, you're seeing the yen, you know, somewhat recovering at times. So it'd be interesting. Is that a big enough risk to really cause a financial crisis in Japan? I don't know how big it is. You look, life insurers are generally trillion-dollar or multi-billion-dollar firms. They tend to be pretty large, but I don't know in Japan how that is. So anyways, so that's an interesting example of people just rolling the dice on currencies and hoping it works out. That's pretty scary. All right. How much of that off the top of your head can you do? What was our first risk? My favorite. You talked about it in paper one. Part of a subcomponent of market risk. Interest rate risk. How do we measure it? Blank of blank. Not on interest rate risk. Blank of net worth. Duration net worth. How do we mitigate it? Balance sheet immunization using Interest rate swaps. All right, there's one. Y'all didn't do too great on that one. All right. What's the second one? Y'all said it already. Market risk. How do you measure market risk? Almost always. Y'all said it already. Value at risk. How do you mitigate it? The number one thing. Diversification correlation. What was the third risk? The one that's a tough one to manage. Liquidity risk. Hard to measure, hard to mitigate. Fourth risk. We talk about credit risk, right? How do you usually measure that? Credit ratings. How do you mitigate it? Limits, concentration limits, those type of things, diversification kind of part of it, right? So you want to be able to, if you're in an interview, you want to be able to roll these things off the top of your head. Value at risk, you notice, came up about 80% of the time. Value risk is a pretty critical one. You see it a lot, and it does work pretty effectively on a lot of these risks. I definitely use it on currency risk, inflation risk, on those areas that it really works pretty well. So have a good understanding of these. All right. You have paper 2. I've got the model out there. Rather than using class time, I think this weekend, I already have one video out there on this, but because I updated the model, I think I'm going to do an entire new video this weekend to walk you through everything so you see how it works. It's not a difficult project. It's pretty cool. You create an efficient frontier. You do a historical value at risk. You do a style analysis, which if you've never done a style analysis, it's easy to do, but it's really quite fascinating. There's a style chart, and then you do a manager attribution. All right. All of those, if you haven't done every one of those, this is your chance to do it. Do not want to graduate without knowing all 4 of those. Anyone done all 4 of those yet? Brendan's kind of getting there. Anyone done all 4? Anyone done one of them? Eastern Frontier. Style analysis. It's a really cool one to do. Value risk, the historical value risk is kind of the simplest thing in there because it's all built there for you. Manager attributions, pretty important. We'll talk about that. Brendan's been building a model to do that. You'll see my approach here. I'm using the Fidelity Fund, which means you can't use the Fidelity Fund on the style analysis. I do the Fidelity Balance Fund, so you can't use that one. So, but I have a whole database of funds that you can use. And if there's one you want to do, there's 2 type of funds. There are balance funds and there's specific asset class funds. Style analysis for balance funds. They have stocks and bonds in them, international. Because what you're doing style analysis, you're trying to figure out where they're taking the risk. Is it U.S. stocks? Is it international stocks? Is it U.S. bonds? Is it gold? Where is that risk? Is it high yield? That's style analysis. Manager attribution is you have a fund that does one thing, like the Fidelity Value Fund. It's a large cap value fund. You're trying to see, did they beat the market and what risks do they do to beat the market? All right, so you have all your funds here. I'm using the total return index, which is really important. I used to use Yahoo Finance. They don't let us do that anymore, so I'm using Bloomberg. You don't need a Bloomberg account because I've got all the data hard-coded in here. So the things I show you are a manager attribution. I do alpha, standard deviation, tracking error, information ratio, batting average, upside downside capture, and beta. There's 3 others you can do: Sharp, Cranor, and Jensen. And I will give you some extra kind of bonus points if you do those. It's not Sharper, it's Sharp. Those are ones you probably heard of. You almost never see Drainer and Jensen in practice. You'll see Sharp, but almost entirely at hedge funds. You almost never see them with mutual funds. So I think we had a hedge fund come speak to Investment Society, or to the security analysis class. He talked about his Sharp ratio. So those are good to know, but I don't make you memorize them. They're ones you can look up and just know. Sometimes, like with Sharp, you use standard deviation as your risk. Sometimes, like with Jensen, you use beta as your risk measure. Standard deviation makes sense if you're doing a hedge fund because essentially a hedge fund is an alpha play. It's not a beta play, so standard deviation is the right measure. So you want to have some sense of these. Undergraduate courses, they tend to really spend a lot of time on these, but I've seen them so rarely in practice. I just can't see spending a lot of time, but it wouldn't hurt you to make sure. Have y'all seen these before anywhere? I don't cover them in my principles of investment class. That's probably where you would have seen them. Um, I think professors in academia think they're used all the time in practice, but they're really not seen that frequently. So I'll leave those three to you. Anybody know these ratios? I'd have to look them up. I think I put them out there. So Sharp is your return minus the risk-free over standard deviation, right? So they kind of have, at least the Sharper trainer, they kind of have a t-statistic kind of feel to them. You're trying to see, is the extra return statistically significant, right? I beat by 1%. Yeah, but your standard deviation is like 37%. Next month it's probably gonna be negative 5%. But I beat by 1% and my risk is like 0.7%. Yeah, that's probably some skill there. You're pretty consistent. So that's somewhat what they're doing. Jensen's a little bit different, but they're all very, very similar. And they're looking to see what is your return versus the benchmark once you adjust your return for risk. Although in Sharp, your benchmark's the risk-free rate, and Trainer and Jensen is kind of the stock market, but that's what they're looking at. We had one of the guys in our real estate company, he wanted a shadow in my department. He had a really strong stats background. We got him for free. I was like, free, that's great, we'll do it. So he came over about once a week, and I asked him, do every ratio you've ever heard of and tell me which ratio best predicts the future performance of a mutual fund. Because that's what you're after, right? And I thought it would be information ratio. Firms with high historical information ratios will outperform going forward. What was the relationship? 0. And then I thought, well, maybe it's Sharp ratio. Nope. Trainer. Nope. Jensen. Nope. There's only one thing that actually worked. Anybody want to guess? Out of all of these ratios, there's only one that was statistically significant. It wasn't. Information ratio is the one that's the most quoted, and there's no predictability of information ratios. Firms with historical good ratios don't do well going forward. No guesses? It's the most surprising one to me, but it's batting average. Batting average is just what percentage of the months did you beat the market? That was it. And it wasn't strong. It wasn't like 98% or something, but it was slightly better. So you can see this firm beat the market 57%. 0.57 is a pretty good batting average, isn't it? I don't watch Major League Baseball, but that sounds like a pretty good batting average. But here, anything over 50 is good. I love upside downside capture. What it's asking is when the market's up, what percentage do you capture? When the market's down, what percentage you capture? You want the upside to be above 1%, 100, and the downside below 100. And you can kind of see their beta is 0.89. You can kind of see, you would expect that. This is I use the contra fund because we used to invest that at UTSA. It's a really huge fund. It has had a really good track record. I think they just lost one of their star managers here recently. But they have done really, really well. You have to be careful on these funds when you bring in their returns. I used to use Yahoo Finance, and Yahoo Finance adjusts for dividends, but they don't adjust for capital what do you call it? Capital gain distributions. And Contra Fund had a massive capital gains distribution every December, and it would take 2 or 3% off their return. You can't do that and get a good analysis. Bloomberg, with this total return function, they adjust for all of that. So you would normally see them have a huge loss in December because they're paying out 2-3% in capital gains, but we fixed that. So be real careful. That's a huge advantage of this function, the total return index, is it brings dividends and capital gains back in so you don't get that huge distortion. So I've adjusted for all that for you. All you've got to do is go in and find your fund, and I'll show you in the video how to do that, and then just run the analysis. A lot of it's already set up for you. What you need to do is don't just do it mindlessly. Stop and think about what you're doing. Stop and think about what each one of these things mean. And what they're telling you. An information ratio above 1 is considered really, really, really good. Theirs is well above 1. I use 2 indices. The S&P 500, large cap growth. Why did I use large cap growth? Well, because you bring up this fund and you go to profile, you will find, guess what? A style analysis. You're going to be doing a style analysis, right? Here's their style analysis. Here they're showing it as core, but it's called the contra fund. That sounds like a value fund to me. But you could argue when you read their prospectus, it would be growth. So Morningstar says blend, but it's not blend. What's the right word? It is value growth. Well, what's the middle one called? Anybody know? Blended. I don't know why Morningstar can't get it right. So it's value, core, and growth. So they're saying this is a core fund, which means you should use the S&P 500. I think reading your prospectus, it sounds like a growth fund, even though the title sounds like a value fund. So I tested to see which one had the higher correlation. You can see the correlations are about the same, 0.9. I could have tried a value fund just to see value index to see if it's more like a value. But it's important, right? Because growth has done so well here recently. It's important which index you pick. But that's what you do on the style analysis. So here you can try a couple of them. To get the beta, you have to have the S&P in there. So that's why I have the S&P in there. Beta is always against the S&P 500 for some reason. So it's a really cool project. It's not that difficult a project. I'll show you a paper that people have done in the past. So I won't put one out there on Canvas because everybody just copies it, but I'll show you what one would look like. So it's good experience. So there's your style analysis. Now, if you work for a firm that does style analysis, they're probably going to use Morningstar or use Lipper. The advantage you're going to have is you're going to know what the software is doing because you're going to do it yourself versus having this black box that just spills stuff out. So if you're interviewing and they say, how do you pick mutual funds? I say, well, if it's a balanced fund, I start with the style analysis. I want to know where they're taking the risk. And they say, what do you mean style analysis? You can walk them through the Excel spreadsheet instead of saying, well, I just go to Morningstar and they tell me. Well, what's Morningstar doing? I don't know. It's all magic. But no, you want to be able to explain it. If it's an individual manager, like a large cap core manager, I'll do the information ratio. I think that's important, but I love batting average. You want to be able to talk this stuff off the top of your head without even thinking about it. What if your parents have a mutual fund? What would you do? Do this. All right. Don't pay 1% to some advisor out there that's going to do this and not even know what they're doing. You can do it yourself for free. So go talk to your parents. What mutual funds are they using, and then use it on the project. That would be pretty powerful, right? You say, hey, Dad, that fund you bought that's a really horrible fund. I don't know why you bought it. That fund hasn't performed well. You're going to be talking like a finance professional, which is what you want to do. So it's a good project, easy project, because I've done most of the work for you, but still a good project. All right, so I'll do it in a video, so y'all just have to start working it through the video. You can probably sit down in an hour or two and get all the Excel done in one setting. It doesn't take that much time to do. I don't have a macro to do the efficient frontier because the Excel macros, at least when we tried it a few years ago, doesn't know how to interpret the result of solver. It looks at it and doesn't know what to do with it. So I haven't, if you want to write a macro and share it with me and get it to work, I have not gone out and told ChatGPT or Copilot. I probably should try that. Maybe it works now. My first hire ever was a student in my risk management class at UTSA. I hired him right out of the class, and that was his first project, was to write a macro to get our efficient frontier model working. So if y'all want to do that for me, I don't like sharing macros with the class because they always blow up somewhere. Something goes wrong depending on the version, or you try it on a Mac and it doesn't work. If you're using a Mac, this spreadsheet should work. Some Macs have trouble with Solver, but it should work. But hopefully that won't be an issue. All right, we're going to shift gears pretty dramatically here. I'm not sure exactly how I'm going to ask this on the final, but there'll be something there. I want to talk about four people who have had the biggest impact on risk management. There are some others out there I'm always thinking about. Richard Thaler, you always think about him. Um, I've read his book. I can't get too much out of his book. There are maybe a couple others that are kind of doing what Annie Duke and Doug Hubbard are doing, but just not as well. So there are some other great thinkers. If y'all know one you really think is great, I'm always looking for new books coming out, new thoughts coming out. Um, Taleb, he wrote Black Swan, Fooled by Randomness, and Anti-Fragile. All three. Any of y'all read those books? Any of them? All excellent book. Well, two excellent books and one kind of okay book. Kahneman, what is his great book? Thinking Fast and Slow. You should all read that book, an extremely important book. Annie Duke, she wrote Thinking in Bets, one of my favorite books. She is a great speaker as well, so go find her on YouTube. And I think I told y'all there's a YouTube where Kahneman interviews Taleb. That is a phenomenal YouTube video as well. I would read the books first. Kahneman is interviewing Taleb. Doesn't make sense because Kahneman's the Nobel Prize winner. But it's amazing how Kahneman got Taleb to squirm in that interview. It's really, really interesting. Taleb is kind of a, I don't know how to say it nicely, but extremely confident person. And he was put on the spot by Kahneman, and Kahneman would just like absolutely crush him and do it very calmly. Like, well, let me ask another question then. It's like Caleb's like, sweating. So what Annie Duke has done is she's taken Kahneman and she's made it incredibly practical by using her experience as a poker player and a poker champion. How do you apply the rules of poker? And she says life is more like poker than like chess. And why is that? When's the last time a chess grandmaster got beat by a novice? Can you think of a time? Has that ever happened in the history of the world? When's the last time a great poker player got beat by a novice? Happens all the time, right? She's saying life is more like poker than like chess. What does that mean? How do you make decisions when you know that's what you're facing? Really, really good book. I don't recommend her second book. I think she may have a third book out. I might read it. I so like the first book, I might chance the third book. Her second book was the first book rewritten. It's almost the same thing over again with some worksheets. And I'm listening to them on bike. It's hard for me to do worksheets when I'm on my bike. So I didn't get much out of it, but I really like, she is a very, very good speaker. I've seen some conferences that she's recorded where she does a really good job. She's very entertaining speaker. And then Doug Hubbard, y'all just saw him. We'll probably spend less time on him because you saw his lecture. Did you like his lecture? Or is it you saw some things he's saying? I wish I could get him to come speak at UTSA. It'd be pretty cool. Did I tell y'all I got to talk to him? Did I tell y'all that story? I think I did. I called his secretary and got to talk to him for like 30 minutes or so. Yeah, it was pretty cool. This is all he thinks about. If he's married, his poor wife. He's like running the distribution of, the chili being on the, did you got, 3 to 17, 7 seconds, whatever. But that's all he thinks about. I'd love to get stuck by him on a 10-hour plane flight. I would just maybe just talking to him constantly. It'd be really great. He would not tire of it. You should see his comments on his book. It's crazy. I mean, he comes back to 3 or 4 paragraphs to any comment. So we're going to hit each one of these. What we're going to do is ask, what is it that they said that's so critical to understanding risk management? We'll start with Nissim Taleb. I've read all 3 of his books. I have quotes from all 3 of the books. I didn't do a great job. I tell you, Black Swan, page 57, that's assuming you have the exact same edition I got. So I'm not sure page 57 is going to be the same for you. But what I did with Taleb is I numbered what I thought was his main points and gave you some quotes under each one. So we're going to walk through him. You might find it a little tedious. I find it really fascinating because these are things that really challenge what you learn in economics and what you learn in your finance courses. They're really challenging, especially they don't like the normal curve. So let's start with Nissim Taleb. So he wrote 4 books. I've actually read all 4 of them. The first 2 are really, really good. Anti-Fragile, I didn't think was a great book, but I liked what he was arguing. He could have essentially done it in 2 paragraphs. So I'll show you the main argument from there because I really like what he's saying about anti-fragile related to measurement of risk versus measurement of fragility. I think that's really a good point. The rest of the book, he's a bodybuilder and he uses too many bodybuilding examples that didn't really interest me all much. The Beta Procrustes, I didn't get much out of. I wouldn't recommend that book. It's kind of a bizarre book. I might have 2 quotes from that book in here. But let's look at what he's going to say. Let's look at the main arguments. First of all, too much reliance on the normal distribution. Why? Because it's so simple. It gives us so much information. If things are normally distributed, boy, we got all kinds of things we can do. But he's saying finance may not be normally distributed. Finance gets paid for randomness. We give people bonuses, big bonuses for pure luck. And he complains about that. He gives examples in the book. Finance is kind of similar to number 2, is often fooled by randomness. We see something, we build a model, we go out and do an investment, and everything we're doing is just pure random noise. And we're making these big bets based off of that. Experts and elites, he doesn't like. They know far less. Why do they put people on TV? What's the number 1 criteria for an expert on TV? Is it knowledge or is it confidence? It's confidence, right? If someone really knows what they're talking about, they're going to be really unsure. And they're going to express it. Right? They're going to say, I think this is the case. I used to love Jean Kirkpatrick. She was the you probably never heard of her, have you? Secretary of State for maybe under Reagan. Media hated interviewing her. They would ask her questions about war risk and what's going on here and here, and she would never give a direct answer. She would say, well, over here it's kind of like this, but we could be wrong over here. I loved it. It's like she admits she's not omniscient. She admits she doesn't know everything, and she gives you the full lay of the land. Someone who's really smart and knows what they're doing is actually going to sound unconfident because they're going to know what they don't know. Someone who doesn't know much is going to be so incredibly confident. Those are the people we put on TV. And that's his argument is, yeah, we're listening to people who actually don't know what they're talking about. And then his main point in Black Swan is the most important things in our lives are actually the rarest things. It's the black swans. Your entire career will be decided probably on 5 days, and most of them are going to happen in the next 3 years, which kind of bothers me. I see students on their phones or not engaged in their classes. It's like you're in like the single most important 3 years of your entire life. You better be engaged because you're going to have 3 or 4 black swans in the next few years. That's going to define everywhere. Your spouse, you're going to meet just by accidentally bumping into them on the escalator. I'll tell you so much. I can tell you my entire life in 5 days. Purely like completely random things. My switch from music to accounting as I ran into Julia between the music building, and I became an accounting major. I switched from accounting to finance because our CFO walked a different direction one day. I mean, these are the kind of things that define. Does that scare you or not? I have students want me to help them the next 50 years of their lives. They're like, yeah, who knows what's going to happen. It's going to be black swans. He's going to say black swans are actually the most important thing, but we actually don't focus on black swans. We focus on everything else because they're a lot easier to measure. But the most important things are black swans. So we'll get into that. That's probably his biggest thing. And then he says the opposite side is we're fooled by calmness. We have a period of calmness and we say, well, that's the norm. He says, no, actually, black swans are much bigger after periods of calmness because we're so complacent. So those are his main arguments. And then his solution is where you get into Kahneman argument. His solution is we should bet on fat tails so we benefit from them. Well, they're so rare. Now, his argument is because they're so rare, they're mispriced. So when you bet on them, you're actually getting something pretty cheap. So when it happens, you make this big gain. That's kind of similar to my investment approach, but not quite. Kahneman says that's interesting, but most people in the world can't do what you're doing. They're not a multimillionaire where they can do that kind of investing. So he pushes back on that, but we'll see if you believe that. And then one thing I do want to talk about This idea of forecasting, we talked a little bit about it. Forecasting should not be about predicting the future. The forecasting should be about predicting distributions. And so we'll get into that. He says similar things. Um, he says, why on earth do we predict so much? Why don't we talk about our record predicting? And I kind of led into that. So there's 8 things he talked about. We'll go through each one. I'm going to read many of the quotes, maybe not all of them. And I want you to maybe not memorize this list, but know some of them off the top of your head, because these are some really, really good things to be aware of as you get into your career. Because you will discover in finance, we forget these lessons, and they are, I think, all of them pretty important. So his argument on the normal distribution is normal distribution works really well in what he calls mediocristan. I hate these terms. Doesn't work in extremistan. So mediocristan is something like the distribution of, we talked about this early in the semester, this distribution of the average of men in San Antonio. Remember we talked about that? You could survey 300 men in San Antonio, get a distribution, and it would tell you that the probability of a 20-foot tall man is impossible. And that would be pretty confident. The probability of a 2-inch tall man is pretty impossible. That works really well. Why? Because it really is normally distributed. But then you do the same thing with wealth, and you ask, what's the probability of a billionaire? It's absolutely impossible. And a billionaire would be further out of the distribution on wealth than a 20-foot tall man would be on the distribution on height. And yet their distribution would say it's impossible. Is it impossible for us to have a billionaire? We might have a trillionaire, right? Elon Musk might be here if SpaceX goes public and be the what? What do we call that? The first Pegasus. So we'll see if that term takes off. He might be the first $1 trillion IPO. So we know there's billionaires out there. How large of a distribution do you need to find that out? Well, until you get a billionaire in distribution, your distribution is not large enough. All right. That's what he says is extremistan. There is a large part of the world. Now, the stock market is probably closer to mediocristan than extremistan. The stock market is not going to fall 3 million%. It's not going to go up 400,000%, but it does have more noise in the tails than the normal distribution. So it's not quite as set. There's things that happened in 2020 that would have been impossible. We recorded that 30% negative GDP in the quarter. That's the annualized number. You would have never gotten that number looking at the normal distribution. And his argument is history tells you what has happened, not what could happen. Sometimes, and this is the point, sometimes a lot of data can be meaningless. Why? Because you don't have that billion-dollar net worth person in there. Sometimes one piece of information can be extremely meaningful. It is true that 1,000 days cannot prove you right, but one day can prove you wrong. For everything you've heard in statistics or probability theory, forget it. I don't agree with that. You probably need this stuff, but so he does kind of exaggerate. One of the most misunderstood aspects of the normal curve is its fragility and vulnerability in the estimation of tail events. We already talked about this. We've seen some 8 sigma, 9 sigma, 10 sigma events. We did see a 10 sigma event in the stock market in 2008. In fact, a few of them, and we saw a 20-something event in 1987. Why is it? Because when you get out on that normal curve, man, it doesn't move much. It's so impossible, and so it just understates. So he talks about wealth here. He gives you the probability. The probability of someone having a net worth of more than $8 million, there it is. Higher than 16 million, can't even be calculated. Do you believe that? There's no 16 people worth $16 million in the world. So yeah, it's just the statistics doesn't work. People will find data in which there were no jumps or extremes and say proof. So he said he could prove O.J. Simpson's is kind of an old story. Y'all don't even know that story, do you? And you should have seen us at USA when they're announcing the end of that case. No one was working. I mean, people are on the Bloomberg terminal watching the news on Bloomberg for the O.J. Simpson trial. But he says he can prove O.J. Simpson did not kill anybody. Why? Because he's seen him on TV hundreds of times and he never saw him kill anybody on TV. Does that sound like a good data analysis? Sounds stupid, but he says we do that in finance all the time. So he does the same thing with George W. Bush. He says, I can prove he's immortal. Seen him thousands of times. I've never seen him die. The guy's immortal. It's like, wow. He gives the turkey story. These turkeys, man, they've lived 8 months, 9 months, and every day is just so good. They're getting fed. And then October, not only they're getting fed even better. It's like, my Lord, look at our distribution. This is the greatest life ever. Is that a good distribution? Is that a good predictor of November, do you think? So it's actually the opposite, right? So we got to look at the data and say, you know what, we could be getting fooled here. The correlation measures will likely exhibit severe instability. We've already talked about that. It will depend on the period for which it was computed. We talked about that. Yeah, people talk about correlation if it were something real, making it tangible. Once you get the bell curve in your head, it's hard not to think that way. Actuaries don't like this discussion because they don't use a normal curve. They use other distributions, and they're pretty smart at this. I got irritated with some actuaries at USAA because they're like, no, I got to work on my model more. And it's like, we've been working on this for 3 months, but I trusted them that they knew the math better than I did, understood the underlying distribution. And they had a pretty good sense. I don't know exactly what actuaries do. We heard it last night with Kirby speaking to my P&C class, a real kind of natural understanding of these risks and always being leery, always questioning, not really being comfortable because we know a hurricane can do something really unusual. But finance, we're perfectly willing to use this data, even though it's been proven not to work well historically. So there's the first one. So you throw out the normal curve, you're probably going to be using it all the time. To get on TV, what do? You confidently talk about it like it's always right, but you want to be honest. You just tell your boss, you know what? It's saying this couldn't happen, but my word, Japan's stock market fell at 90%. There's no reason the US stock market couldn't fall 90%. Oh, but it's never happened before. Yeah, but that's no proof. And in the Great Depression, it came pretty close. The NASDAQ came pretty close. But the normal distribution says it can't happen. Yeah, but the normal distribution doesn't know anything. All it knows is history. We're talking about the future. The second thing he says, let's see if we can get the second one in here. You get paid for random luck. So our performance is often just random luck, but our clients pay us for it. He talks about it as Russian roulette, but we're pointing the gun at our customer, not at ourselves. And we keep pulling the trigger and see how good I am. What happens each time you pull the trigger? Does risk go up or does it go down? It goes up, right? So we tell our clients, hey, we pulled the trigger, nothing happened, pay us another 101%. And eventually it blows up and we say, well, what are we going to do? Markets do this. So that's the way we manage. We have moved from an ownership society to an agency society. This is coming from Jack Bogle. We talked about this earlier. We manage career risk. We don't manage our clients' risk. We're agents. We almost don't care if it comes down as long as our customer doesn't take their money away from us. We've stopped managing money and we've become marketers of random outcomes. This is so true. I saw this year after year, Fidelity would come in and say, hey, here's 50 mutual funds we're really pushing right now. And I say, why aren't you pushing the other 450? Oh, they haven't done well the last 3 years. Well, you have 500 funds. What's the chance you're going to have 50 that have done well the last 3 years? Pretty good. What are they pushing? They're pushing randomness. I actually want to look at the ones that have done poorly the last 3 years because I believe in reversion to the mean, but they don't show us those. Why? Because they're marketers. They're not investors. We have stopped managing money, but managing random outcomes. I think you add value in finance through superior risk management, not by superior stock picking, but you can decide on your own. It is somewhat ironic. I'm in charge of our student-run portfolio. We are beating the market. I think it's probably random noise right now, but we'll see. Maybe over the next 50 years. The Spurs had a really good start to their season. And I was like, yeah, maybe they're just lucky. What does it look like now? Looks like it was real. But is it possible for them to go 5-1 and have a horrible season? Yeah, but they didn't. They've had a good year, but I was skeptical at the beginning. A successful person will try to convince you that his achievements could not possibly be accidental. Just as a gambler to say have some skill, the reference point argument follows. Do not compute from the advantage of the winner, compute it from the advantage of the loser. Um, at any point, the richest traders are often the worst traders. He gives some examples in the book of this, of traders who were like, telling them how great they were. And they had these fancy apartments in New York City. And 1 year later, they were fired and selling their apartment and moving out. Were they a genius 1 year and stupid the next year? Or was it just good luck and bad luck? Um, the most successful traders are likely to be those best fit for that particular market cycle. This doesn't happen in Mediocristan. You don't go to a dentist and, sometimes they do really good and next time you lose all your teeth. Oh man, I thought it was really good. I got three in a row really well. You're pretty confident. If someone sat down at piano and played a Beethoven piano sonata flawlessly, do you think there's random chance there? You think someone who's never played the piano before would just sit down randomly? But what about someone buying stocks and beating the market? Could that happen randomly? It's a very different world of finance than other worlds. And we don't do that. We just say, hey, wow, they did really well in the stock market. I remember at USAA, we had a manager who had like 3 really good years. And in the committee, I go, I don't know if it's skill or luck, but we're glad he did well. And the president of the investment company said, you don't have numbers like that if it's not skill. Guess how that manager did the next year? Horrible year. But is it skill or luck? We don't often know. Um, so he gives this example of just, there's actually some scammers who do this. Um, you mail out 10,000 letters, you make a bet one way or the other. 50% of them will be right. So those 5,000 you send out a letter, make a bet 50%, 200, 2,500, those are going to be right. You mail out 2,500 letter. What about 400 people think at the end of this? Wow, this person's a genius. Are they a genius? No, you just fell for a scam. There's actually a Twilight Zone on that where a guy goes for that and he actually gives the guy all his money and the next bet he actually wins and he retires and leaves and he was part of a scam, but he was just lucky. He was on the last 50% that won. But that is an actual scam that happens in finance. And then the last one, we have all these books about what do successful CEOs do. So you want to mimic them. What does the book not tell you? That's the exact same thing unsuccessful CEOs do. Oh, wait a minute. Oh, they read every day, they get up early, they exercise. Yeah, successful and unsuccessful CEOs do the exact same thing. All these books tell you just randomly what the successful ones did. If they don't tell you what the unsuccessful ones did, it's of no value. All right, so we'll start at number 3 on Thursday night. Why is private credit so different than public credit? And it really is a different animal. It's just public credit is, other than treasuries, is pretty illiquid, but private credit is extremely illiquid. So it has those liquidity issues that we had. And so when everybody wants their money out at one time, it has huge impacts on those markets. That might be that Minsky moment we were talking about where, the next liquidity crisis is where the crowded trade was, and private credit was a crowded trade. And now you're seeing the aftermath of that. All right, we've been talking about Nissim, and the first thing he talked about was forget about the normal curve. In certain places, there's a lot of places it doesn't work. There are places it does work very, very well, but a lot of times in finance, we use it in places it shouldn't. The second thing is finance pays for results, whether it's luck or skill, because we have our incentives are built that way. We almost are encouraging going to Vegas. So the third thing he said is really similar to this, is that we're often fooled by randomness. We see patterns when they're really not there. Why? Because again, we're paid to find patterns. Our bosses are incentivized to go find something and say, well, this worked the last 5 years. Say, yeah, and because it worked the last 5 years, it's highly unlikely to work the next 5 years, but we don't. We see something, we got to make a decision. So the more information you give someone the more hypothesis they can come up with, they see random noise and mistake it for information. Um, there's a great book, and I forget the writer name, distinguishing noise from, actual data, and there are statistical ways to do that. That's something Doug Hubbard talks quite a bit about. But in finance, we tend to be like, no, I gotta do my job. The problem is that our ideas are sticky, so you see the pattern, you invest your ego, and now you refuse not to see the pattern even if you get new information. And so investing your ego is the biggest probably problem with it. Um, so our ideas get sticky because we invest. So one of the tricks, we'll see this with Annie Duke, is don't invest your ego. Always give yourself an out. Don't tell your boss. Don't use declarative statements. Start sentences with I believe, I think. Don't say, the Fed's definitely cutting rates this year. You would have said that in December. Now you'd be kind of like, well, maybe not. So, always, if you're not 100% sure, and what are you 100% sure about in finance? That we're not 100% sure. That's about the only thing we know. So, always caveat things. And remember, if you put a probability on it, what does Doug Hubbard say? Stretch it out because you're really not that sure. Oh, I'm 60% sure. No, you're probably about 20% sure. So when you develop your opinions based on weak evidence, you will have difficulty interpreting information that contradicts that. Remember in that Paul Sappho article we had, he said, have your opinions, hold them weakly, weakl, be willing to change them pretty rapidly. If you put your mindset into it, it's kind of like what I was talking about with reading. If you make your mindset to reading articles, reading books with the goal of having your mind changed, that's what, if you get your mind to be changed, it's good news. That's what you're after. You change your incentive to that, you'll do much, much better. Um, we tend to put our judgment in far too quickly because we're paid to do that. I love this phrase. Are we better at explaining and understanding? And that's somewhat what finance people do. I think other careers do that as well. But our bosses want us. My boss was like that. Like, what's going on in the market? I'm supposed to come with an answer. The real answer is I don't know. It's just wild. I don't have a clue what's going on. I don't understand the stock market right now. It's like, oh wow, Iran's been solved. Well, it doesn't feel like it's been solved. It sounds like it's like about as uncertain as it was 2 weeks ago. But who knows? We still got the Russian war going on. You still got the Israel, Palestine, which, all these things are pretty uncertain. So, the market's reacting positively. Should it react positively or not? I don't know that. Do I have an opinion? I think the market's maybe getting ahead of itself, but I could definitely be wrong on that. I'm not going to bet the farm on that. But your boss wants a declarative statement, which is just the way we're we're taught. I love this as well. Um, we think it's smarter to say because than to accept randomness. What's the right word if it's random? There's no because. I mean, it's why is it moving like that? Well, because it's moving like that. That's just what it's doing. I don't know why it's doing that. Um, so you might ask, why did those 6 lottery tickets come up? Numbers come up. What's your cause on that? Because those are the numbers that came up. How many people pick their 6 lottery tickets? 1, 2, 3, 4, 5, 6. Has anyone ever done that? Why don't they do that? Because it's almost impossible for that number to come up. What else is also impossible? 1, 7, 12, 15, 32, 6, but our minds think that 1, 2, 3, 4, 5, 6 is less probable than all the other combinations. It's the exact same probability. So, it's strange where our minds do these statistical things we know are wrong, but we do that. So we put because into a sentence when we really don't know why something's happening. The biggest problem with the educational system lies precisely in we as professors force you to put because things. That's why I don't like the Harvard Business case study approach. They give you a case and you're supposed to say, oh, that happened because of this. Maybe a different strategy to work. It's possible there's 5 strategies and all 5 of them would have failed. This is a company that's just not going to work out. Who knows? So have the integrity to deliver your because very sparingly, but your boss is asking for that, so you have to figure out some way to manage that. He also thinks we're part of the problem is we're getting too much data. I love The Economist. It comes out weekly. That seems about right. The Economist keeps pushing more and more frequent stuff on us.
How did you manage it with the I don't knows and
Well,
but
I learned a lot from Mark, our gold fund manager. I think I talked to somebody about that. If he didn't know the answer, he said, I don't know. And people ask, he's this incredible gold investor. He's just incredibly, he outperforms all of his peers. You ask him, what do you think gold's going to do? He's like, I don't know. I think it could go up or it might go down, but I also think there's a chance to stay about the same. And why did he say that? Because that's what he knew. He would tell you exactly what he thought. And it frustrated my boss so much. Says, how could he not know what gold's going to do? Well, he doesn't. I remember talking to oil traders on the futures market. It's like, what do y'all think oil's going to do? Oh, we don't know. It's like, what? And why didn't they know? Because that's their market. They know no one knows. They didn't have you would think they would have an opinion. It's something I talked about a little bit on my podcast today, right? Is the smartest people are the least committal because they know they don't know anything. Who's the people who say, I know it for sure, is the people who don't know much in most committals. So if you put it in your mind that, the smarter you are, the more less committal you are, the more you admit. I mentioned Jean Compactor. I was watching a documentary on her and just her brilliance, and it made it frustrating because she just would, she would say some pretty brutal things. But I like people like that just like, you say what you actually know for sure. So anyway, you set it up and you just pick and we'll talk about a little with Annie Duke is you use more probabilistic terms. So if your boss says, what do you think is going to happen? Right now I'm about 40% that the Fed's going to cut, 60% they're not going to cut. I actually think now there may be a 10% chance they'll raise because the next CPI, we're going to get a CPI number on Friday that's going to include all these energy prices. Through March, we could see a year over year up 4%. That could be interesting, right? That's going to be pretty freaky. So is it possible the Fed might raise rates this year? Obviously, I would not have thought that in December, but now I definitely do. But in December, I think I would still say there's a 5% chance. So if you speak probabilistically, it gets you somewhat out of that investing your ego into it. But we get too much information, too much data. So I know some of y'all like the Wall Street Journal. I never liked the Wall Street Journal. The only thing I ever read was the editorial page. It's just so much noise. And what he says is read the Wall Street Journal, but read it 1 week late. And you're going to find that you're going to be like, oh yeah, that didn't happen. Yeah. So I like The Economist. Comes out weekly. Maybe weekly is too frequent, but it tends to look at longer term things and not so much shorter term stuff. So one thing you can do is maybe filter the information so you don't get so much just this constant noise driven at you because your brain will try to synthesize it in some way that you're turning random stuff into some kind of pattern. Um, so spend the year reading the previous week's newspaper. I wouldn't waste your time doing that, but that's essentially what he's arguing. What do y'all read? Do y'all read the Wall Street Journal? I mean, you kind of do it because you think you're supposed to, right? I like the Financial Times a little better, but there's still. I read the Financial Times, and Wasif, the guy who worked with me, he read the Wall Street Journal, and if we saw something, we'd share it with each other. Um, but I prefer The Economist. I do read The Economist every week. I do really like it because it takes you around the entire world, so you have a good sense of what's going on around the world. And then I memorize all the countries of the world, so if I hear a country name, I can see it, what's around it. I think that's really important. You know what's going on, but it's only weekly, so it's not quite so much noise. All right, so there's this third argument. You do need to figure out a way that addresses. Andy Duke will give us a few hints there. He doesn't like experts. He has a pretty low opinion of them. And again, it's because the experts we have are the ones who are willing to commit when they really don't know what they're talking about. So he says we rarely go back and see how good they were. I saw an interview with Dr. Doom. So what did Dr. Doom get right? 2008. What has he gotten right since then? It's just not, but it's actually you should almost there is a strategy that you just constantly call extremes and you're wrong 500 times in a row and then you're right and you call the 2008 crisis and suddenly every conference you go to, oh, this is the guy who called the 2008 crisis. And you got it, just keep predicting it. So just go out and say, hey, the Fed's going to raise 75 base points this year. They probably won't. Fairly unlikely. But what if they do? You're a genius. Right? So there is something along that side of going out and just being bold like that. It doesn't add any value to people listening to you, but it might work out. But in your job, there's really no advantage to doing that. So again, remember, in my opinion, the purpose of a forecast is not to predict the future. The purpose of forecast is predict the distribution of the future, and you should make it as honest as you possibly can. Have those tails very, very wide. Um, Nobody knew anything, but elite thinkers thought they knew more than the rest because they were elite thinkers. And if you're a member of the elite, you automatically know more than the non-elite. This is where you'll see this guy's name in here. I forget, he doesn't show it here. Um, there are some interesting studies of how much more do experts know versus non-experts, and it's pretty scary how much money we pay the people who are no better than random chance. He says the expert is the closest thing to a fraud. He always puts experts in quotes, performing no better than a computer using a single metric. Doug Hubbard talks about this. So Doug Hubbard says, what's better, using statistics with a little bit of data or relying on an expert and their intuition? So think about, what is intuition? Intuition is bad statistics applied to faulty memories. Because what does your memory do? Your number one goal of your memory is to prop up your ego. So your memory is to remember things really, really bad. These podcasts I'm doing, I'm probably like making myself look a lot better than it really was. Who knows? We'll talk about memory when we talk about Kahneman. It's pretty interesting what he says about it. When you watch this video, he talked to some about that. But the intuition, what is intuition? It's really bad statistics and really bad memories. And I've seen people that say, oh, no, we can't trust that data. I've been in this business. I got experience. I got intuition. But you really look at their intuition and it's not that strong. I think this is one area AI is going to be strong on, because AI is going to say, you make this decision the same way every time. This is the data you're relying on. It's your intuition, is your experience is really not all that sophisticated. I remember my boss was managing the bank portfolio. I shouldn't put this on the video, but managing the bank portfolio. And I told him, it's kind of dangerous. You're the only person that knows what's going on. It's a small portfolio, a few $100 million, but it's still important to the bank. So I convinced them, I had a guy in my department that wanted to learn it, say, train him. And we went in the first session and he wouldn't tell us anything. He was like, oh, he was really ambiguous. And it's really frustrating. It's like, how did you pick that bond? And after about 3 weeks, the guy who was training, he says, Ron, I figured it out. Every time this number does this, he buys. When it doesn't do that, he doesn't buy. And after that, every bond he picked was exactly what the boss said. He says, it's really simple. But he made it feel like he had this intuition, this experience. He was really sophisticated. And I think a lot of our algorithms are a lot simpler than we're willing to admit. We really look at it, and what is AI going to do? The AI is going to figure that in a nanosecond. So we need to admit our intuition is probably not nearly as good as we think it is, because we're remembering what we've done so badly. I'm not saying that no one who deals in the future provides any valuable information, but rather those who provide no tangible value are generally dealing with the future. The problem with experts is that they do not know what they do not know. They are quite ashamed to say anything outlandish. You look at economists' forecasts, they're amazingly close to the latest number. So if the last number was 2%, they're going to be between 1.8 and 2.2. They don't jump way out there. It turns out what actually happens is almost always outlandish, or will be. Economic forecasters tend to fall closer to one another than the resulting outcome. That shouldn't be true, right? They probably should be more dispersed. And a study comparing an investment analyst with weather forecaster, who do you think is worse? Weather forecasters get a really bad rap. I've been on my bike when it tells me it's raining and the sun's out. And then I go out riding, it's going to be clear all day, and it starts raining 30 minutes in. but weather forecasters are better forecasters than finance people. So that's kind of scary. Those who have big reputation were the worst predictors than those who had none at all. These studies collectively show no convincing evidence that economists as a community have the ability to predict. And if they have some ability, their predictions are at best just slightly better than random noise. Um, Statistical sophisticated or complex methods do not necessarily provide more accurate forecasts than simpler ones. That's somewhat what Doug Hubbard's saying. Sometimes we fool ourselves by how complicated the model is. Uh, the far, the world is far too complicated. So we look at his world, it's really, really complicated. We think, well, if we make the model more complicated, we'll get closer, but actually probably it's pulling us farther away. So, so be careful on this. This is somewhat to just be a little bit sober when you get into this industry and just if you can get you remember Descartes. Well, I don't know if we'll talk about Descartes. What did Descartes say? What's his famous phrase? I think, therefore I am. So he has a great um, philosophy. He asks the question, what he says you should do this about once a year. If you do it, it's going to drive you crazy. But he asked the question, what do I really absolutely know for sure? And says, do I do I exist physically? I mean, it's possible I was created 5 minutes ago as a computer program and given 63 years of really vague memories. Someone's writing a program. They want to see how a boring college professor react if a 1,000-foot grasshopper suddenly attacked UTSA. They just want to see how I react, right? That I don't really exist. I'm just a computer program. So he's like, yeah, I don't really know. Like what's the one thing I do know? I'm thinking, therefore there's something of me that exists. I don't know if it's physical or not. So we don't know much. I'm not saying go quite that far as a finance person, except that you physically exist and all that. Um, but what do we really, really, really know? And he says test every single thing you believe and test it hard. Not all year long, but one day out of the year, go out into the field, lay down, and just say, what do I really absolutely know? Um, so we're really somewhat in the dark. Um, but we tend to be far, 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 far more confident than even that. I mean, we're off the charts too confident in our ability to forecast. All right, let's talk about black swans. He says the world's pretty boring most of the time and not that important, and every once in a while something major happens. And that's very, very, very true. It's true in your life. It's true in your corporation. Very, very, very big things happen every once in a while. I'm not, it's amazing to me students that aren't engaged because these are your most important 5 years of black swans right now. These 5 years of your life, probably your 3 or 4 biggest black swans of your life will happen next in these few years and will determine the next 40, 50 years. Diana was talking today about her trip to Goldman Sachs and then the Blackstone. Um, did she become an MD because she was better than everybody else? Probably, but there's also probably because she happened to meet someone in the hall one day and made an impression. These things, it's amazing how much rare events radically change our lives. But we ignore them. Why? Because they're so rare. So when you're forecasting, you got to realize you're forecasting, most of what you're forecasting is the boring stuff. The one thing you're not forecasting is the most important thing, which is the black swan, but it's because we don't know how to forecast black swans because we don't know what they are. So we're forecasting the unimportant stuff and leaving out the most important stuff, and then we have to ask, why are we forecasting? Um, they ultimately turn out to be the most important. He says a small number of black swans explain almost everything in the world. Ordinary events, the ones we study and discuss and try to predict, have become increasingly inconsequential. The normal is often irrelevant. Why do we focus on minutia and not these large events? Life is cumulative effect of a handful of significant shocks. He says history doesn't crawl, it jumps. He says this implies we need to use extreme point as extreme as the starting point and not treat it as the exception. So you're gonna have black swans in your personal life and your in finance as well. Um, will you see another 2008 in your life? According to Taleb, he says the world will become much more stable, followed by a crisis, even more stable, followed by a bigger crisis, even more stable, followed by even bigger crisis. If you believe that, how do you manage people's money in markets? And what do most people do? They just say, ignore that because we can't do anything about it. We'll just keep stable. Nissim talked about black swan investing. Most people can't do that, but that's somewhat what he's talking about. But maybe you do a little bit of that. Maybe you have something that's going to at least protect you from 40% of it, 50% of it. I definitely believe that if the VIX gets below 10, go for it, buy a lot of protection because it's so cheap and get yourself just in case, the extreme happens. But this makes finance much more difficult, no question. I don't think there really is an answer other than if you believe in black swan investing. I don't think there really is an answer on this other than just be aware it's gonna come, and when it comes, it's gonna be pretty painful. Um, he talks about flights like that, right? Flights have big black swan. You don't arrive 6 hours early on a flight, but you could definitely arrive 24 hours late. Um, and they talk about worst case scenarios. What's a worst case scenario? It's the worst thing to happen through that date. But the next worst case will be bigger by definition because it's the new worst case scenario. Um, that's called stress testing. Y'all talked about stress testing in your paper one. Um, so so what are the black swans? Um, with mine, I was a music major, and I figured out what a miserable life that's going to be. I worked for, I was teaching some sixth graders. Oh my word, how miserable that was. Sixth grade French horn players. You take the entire lesson just getting them to play the right note, and they finally get it, and then you do the orchestra, and then they lose it, and you got to go, okay, no, da da da, not you're. It's just, oh, I was like, am I going to do this the next 50 years of my life? There's just no way I'm going to do that. But now what am I going to do? I'm at UT Austin. I'm 4 years into my degree. And actually what changed it was talk about a black swan. I was in my conducting class and the professor was so mean. We had two professors. One of them was so mean. He's always in a bad mood. And I was up and he wasn't grading. He walked in the room late and I did my thing. And for the first time ever, he complimented me. Great job, Ron. He never complimented me before. Now, why would that make me change majors? Because the woman who was grading, she handed me the grade sheet, and instead of she had given me a B, and she changed it to an A minus, but instead of giving me a new piece of paper, she erased the B minus and gave me the B and gave me an A minus. And my interpretation was she's telling me I gave you an A minus because Glenn said good job, Ron, but we all know you're mediocre and will always be mediocre. That's how my mind interpreted it, and I changed majors that day. Is that a black swan or what? If he hadn't walked into the room, I would have continued with it. So, I mean, that's pretty radical, isn't it? And I go from there and I'm walking back to music building and Julia walks up and I say, Julia, I'm going to switch majors. I was thinking maybe computer science or accounting. She says, don't do accounting. My roommate's an accountant. She says it's really hard. So then I became an accounting major. I mean, what kind of planning? I mean, these are black swans, right? And then a few years later, I'm an accountant. I'm doing great. I'm moving up fast. And the CFO walked by this way instead of that way. I'm trying to show off. I said, I saw a job on the board, thought it was interesting. I didn't want it. I was just kind of showing off. 2 weeks later, I'm in finance. So I went from music to accounting to finance because of people I just happened to, because one person couldn't use another little piece of white paper. I wish I'd kept that little piece of white paper because it's pretty material. And then Julia happens to walk left instead of right. And then my CFO. Can you believe that's going to be your life? But that's what it's going to be. So, it's hard to plan. Students want me to plan the next 50 years of their lives. So it's like, no, you just do well at what you're doing right now and be ready to move. And I think the best thing you do is when an opportunity comes up to change, you change. The scarier, the better. So I can't think of any time I'd switch jobs where it wasn't in my best interest to do so. So there's sometimes where you almost set up a black swan. So, the CFO walks by my office. or my desk. I didn't have an office, my desk. And I make that comment and now have the opportunity to move. I move. I don't back out. Oh, I really don't want that. You just change. I was scared to death of that job, but it worked out extremely well. So just be aware of those things. But all three of those happened in a pretty short window of just a few years. So be ready for it. Those later in your careers, I don't know if you agree with me on that, but I mean, y'all could probably tell your own black swan stories as well. Have any of y'all had black swans yet in your life? Some of y'all finance majors now because you got on the elevator with the wrong person, or actuarial science, right? How do you even figure that one out? Talks about that. All right. And then we're fooled by calmness. So we're fooled by randomness. We're also fooled by calmness. We love calm periods of time. In the 90s, it was a very, very calm period of time. Just nothing really bad happened. We tend to say that's the norm now. We get used to it, and it makes us do things that don't make sense. Um, and then the extremes happen, and the calmness actually makes the contagion worse because everything's gotten intertwined in a way we weren't expecting. And suddenly, when the volatility hits, it just goes big. We'll talk about that with Doug Covered quite a bit. And he says we're actually encouraged to bet on the wrong type of calmness. We don't like volatility, so we tend to invest in calmness, the type of calmness that when it blows up really, really bad. That's his complaint with bankers. He thinks banks do things that look really calm, but when they blow up, boy, they blow up badly. Um, so there are certain types of cultures and professions and industries that tend to be more susceptible to that. Um, and then he talks about finance versus other fields. So the airlines industry, every time there's a close call or a crash, they delve into it in detail. They want to make sure all future plane rides are safer because they looked into it. Um, so in that case, these events make things safer. These systems learn because they are anti-fragile. So what does anti-fragile mean? So let's define that up because this is I like this concept. So there's fragile, there's resistant or resilient, and there's anti-fragile. Fragile is you're destroyed by volatility. Resilient is you're hurt by volatility, but you survive. Anti-fragile is you actually benefit from volatility. Those are the three groups. He says the airline industry is actually anti-fragile. It actually benefits from these close calls, these events. It's not good, obviously, for the people in the event, but the system gets better. It's anti-fragile. You might say that's true with autonomous vehicles. We'll see, but autonomous vehicles, if they discover something that's not good, they fix the software and suddenly every autonomous vehicle in the world is driving better, hopefully, unless all of them somehow get corrupted at the same time. So they exploit small errors because small errors really, really help them learn. And I love those TV shows where they show these historical events. Some of them, the people all survive. Some of them are pretty quite tragic. Um, but some of them are pilot training. Some of them are mechanical, how the plane's built. Some of them are the people in the tower. Each one of them, they document it and figure out exactly what's going on. And so, aren't you glad they do that? Would you have gotten on the plane in 1940, knowing what you know now? Be kind of scary. Um, he says it's the exact opposite in finance. You cannot say this about economic crisis. Economic system is not anti-fragile. Why? There are hundreds of thousands of plane flights every year, but they're independent from each other. And a crash in a plane does not involve the other, so errors remain confined and highly, I don't know what that word means, epistemic. You all know that word? So someone looked that up and use it this week. So use it if you don't know what it means. Wow, that's really epistemic. But it sounds like someone look it up and let me know. That's a cool word. Global economic systems operate as one. They're interconnected. Errors spread and compound. Good systems such as airlines are set up to have small errors, independent, negatively correlate each other. since mistakes lower the odds of future mistakes. If every plane crash makes the next one less likely, every bank crash makes the next one more likely. Um, so it's part of, you're in a profession that this is just the nature of profession. We don't learn well from our mistakes, and we repeat the same mistakes over and over again. We get fooled by a few years of calmness and still repeat. Well, it's how does this help you in finance? I don't think there's, again, a perfect solution for this, but you should always be aware of it. Part of it is, I don't want to be cynical, but you should be skeptical. You should be questioning things. We'll talk about Annie Duke today. David heard me talking about decision pods and how that can help you. This is the kind of thing you want to bring up to say, wow, this is really the right decision. But at the other side, you don't want to get so into this to become catatonic and you can never make a decision. So you got to figure out how to balance these. But I think Nissim is telling you some things that you should always have in the back of your mind. So he has a solution. He listened to the Taleb Kahneman debate or discussion. Kahneman doesn't believe everybody can do what Taleb is saying. Taleb says we should bet on fat tails. You should make sure you have something in your portfolio does extremely well when the next major crisis happens. What could that be? Options are the most obvious thing. An option can be up 40,000% in value pretty easily. So in 2020, he was famous for having done extremely well when COVID hit, but I bet he didn't come out well at the end. So he was great when this market dropped all that way, but did he get out in time before it came back? Because it was a V, right? So I don't know. He got a lot of press, good press at the bottom. I didn't hear much from him on the way back up, so I don't really know. Um, so it's interesting. I was lucky in '08. I was doing a corridor trade, which was working great. Um, so you buy at the low, you sell at a lower high, you buy at a lower low, you sell at a lower high. I was doing that. And then August, September came along and I'm retiring in '09. I'm sitting in this job that's incredibly stressful. And I go, you know what? I can't take the stress. So I just moved to cash. And then the market tanked. And I was like, I'm so glad I was retiring. Is that smart? No, that was just incredibly lucky. But yeah, I was just like, the stress was just getting to me. And it's like, the last thing I can have is I got my job crashing and then my portfolio I'm retiring with is crashing. I'm just going to move to cash and just extremely lucky. Boy, that will never happen again, but just lucky there. That wasn't betting on a fat tail. I just moved to cash. So he says 10 to 15% of your money is going to be in these black swan investments. Most people can't afford to do that. That's just too much. You're talking about something that most of the time does horribly, and every once in a while does extremely well. Most people cannot get away with that. So, but the other 15% in extremely speculative bets, levered like options, but they need to be things that are going to do well when everything's crashing. So you got to figure what that is. Options do pretty well on that. Put options, the ones that are they're the bearish kind of options. But you do that in the 1990s, and boy, your portfolio is going to really underperform everybody else's. So do you have the staying power? You might be able to do this if you're a multimillionaire and it's your money. But if you're managing other people's money, what risk are you managing? You're managing career risk. This would destroy career risk. You could not get away with this. So it's interesting. But could you take 1 or 2% of your portfolios so that 30% drop becomes this 8 or 9% drop? Yeah, you could afford to do that. That's part of my philosophy now is I want to be smiling when everyone's laughing and laughing when everyone's crying. So it's kind of like I'm going to be mediocre in the great markets and then I want to be doing well in the crashes. I can get away with that because I'm kind of at a point in my life where I can kind of handle the mediocre during the great years and then really make out in the bad years. Um, so do not try to predict the precise. He says don't say what is the black swan going to be. To me, it might be China attacking Taiwan. I don't know what that's going to be. I would imagine markets would sell off 20, 30% if that happens, but who knows? precisely, it would be pretty big. But he says you don't be so precise. It's going to be something. Um, you look at Russia, Ukraine, U.S., and Iran. We were kind of talking about those things the last few years, but it was still somewhat of a shock when they happened. Um, I don't know if people are talking about COVID all that much. George W. Bush was somewhat talking about it, but that was 10 years earlier. Um, so, how precise you have to be. You want to think about something that's going to cause markets to crash. Where does the precision help you? Well, precision helps you predicting, deciding which option you're going to do. So if I'd known in 2008 we're going to have a financial crisis, I would have been buying options on bank stocks. But can you be really that astute? Maybe you look at the subprime lending, it's pretty tough. So this is probably something you can't do. You're probably just going to stick your money in the stock market and just hope for the best. But again, if over your lifetime the stock market doesn't do well, nothing probably did well, and you probably should just bet on the stock market and go with it. Your question is, do you bet outside of the US? Because the US has done so well the last 20 years. Maybe there's an argument there. So you have a few decisions on how you're going to diversify your stock exposure, but you're probably just going to be 100% stock and just hope for the best. But for people like your grandparents, there's probably some truth to this. I talked about put 100% in stocks when you're 70 and then hedge it. I think you'll do pretty well, although I think bonds are actually pretty decent now. And if tips get up higher in their yields, I think tips are a pretty good play right now. Um, he says, I worry less about small failures, more about large, potentially terminal ones. I worry less about embarrassment than missing out on opportunity. I am very aggressive when I can gain from a black swan, when a failure would be of a small moment, and very conservative when I'm under threat of a negative black swan. Um, so he's talking about skewed bets with about, he says 10 to 15% of your portfolio. I try to benefit from rare events. This phrase sounds pretty horrible, doesn't it? He wants to make money infrequently. The rarer the event, what does that mean? It's going to be real cheap to bet on it. So the rarer it is, the cheaper it is to do the bet. So you might look through those, what those might be. People say the U.S. stock market can't drop more than say 50%, kind of like it did in 2008. But Japan is an awfully huge stock market. Japan, I don't know if y'all realize, Japan was not only the largest stock market in the world in 1989, except for the U.S. You take the U.S. out, but it was essentially half of the world market outside the U.S. It was a massive, massive stock market, and it fell over 90%. Is that obviously it's possible? You saw NASDAQ fall 90%. These are big markets that are falling. So is there any rule that says the U.S. S&P 500 can't drop 90%? There's no rule that says that. It's certainly possible. I don't think that's not my scenario. But I do have strategies where I'm looking for markets to crash, where I have strategies that force me to get in after 30%, 40% drops. So yeah, I do get bold and start jumping in markets there. But who knows what could happen to US. Um, so my opinion, okay, so here he talks about a meeting he had. His opinion was that the market was more likely to go up than go down, but that he was going to short it. And the people in his job like, why in the world would you do that? And he says, because if it goes up, it's only going to go up 5-10%, but if it crashes, it's going to crash 30%. So it's more likely to go up, but if it goes down, it's going to go down a bunch. So I'm going to bet on it going down a bunch because right now that's pretty cheap to buy the insurance for that. So it's not just how likely is something to happen, but when it happens, how much is the upside and the downside on that? We do that in the security analysis class. What's your upside? What's your downside? So you can see, you might think this stock is good, it's going to go up, but however, if this happens, boy, this stock's going to drop 40, 50%. That would probably keep you out of it. So anti-fragility is not resilience. It's not robustness. The resilient resists shocks and stays the same. The anti-fragile actually makes money on on these black swans. Um, I like this phrase. This is actually one of my favorite parts. In fact, I think this is the entire book, Anti-Fragile. So if you read this paragraph, you can skip reading his book. He says, fragility can be measured, risk cannot. And there's a famous article called Defining Risk that Glenn Holton wrote. Glenn Holton's in the business of selling risk management products. I love the article. I signed it to my staff. I used to sign articles to my staff that we talked about in the staff meeting. They hated it, but I always loved it. I signed them that article. They hated that article. It was just too philosophical. But you read this article on defining risk, and the last paragraph, he says, forget defining risk. We can't, or measuring risk. Forget measuring risk. We can't measure risk. We can only measure our perception of risk. The right answer to ask is not can we measure risk. The right question to ask is not can we measure risk. The right question to ask is the measurement we're doing of any value? This is a guy who makes money in risk management. And his last paragraph kind of says, why are you guys paying me money? And I was like, what does that mean? So Taleb is somewhat in that argument. Risk is not measurable outside of games of chance where we know, a flip of coins, 50%, we have this precision, but fragility can be measured. And he says that's what we should be focused in on. We should be looking at our fragility, our anti-fragility, look at our exposures. We shouldn't be trying to measure risk because we'll go get it wrong. The next time is going to be much different than the last time. I like that concept. I thought that's pretty interesting. Anything that has more upside than downside from random events of certain shocks is anti-fragile. Reverse is fragile. How will you figure out who's the most anti-fragile? It's the ones that go out of business in 2008. Should it have been known in advance? Yeah, I think the investment banks were definitely fragile because of their heavy reliance on short-term debt. Could have kind of seen that coming. But anyway, this is to me is the best part of the whole book, Anti-Fragile. You might not think it's all that interesting, but I think it's interesting. One thing he doesn't do in the book is to tell you how to measure fragility. But you can do it somewhat with scenario analysis. What if the stock market falls 50%? What if oil prices go to 250? What if inflation goes to 15%? You can kind of do it with those type of analysis to see who's most exposed. And then forecasting, we've talked about that a lot. So you shouldn't make bets based on your forecast. Just doesn't make sense. So how many won the March Madness this year? Nobody. So it's practically impossible, right? If you were Warren Buffett making $1 billion bet, would you bet on March Madness? There's a forecast that is what? It's pretty measurable. What's the chances he's going to lose that bet? It's pretty low. I don't understand why he's making a bet because I don't know what money he's making. Is he making any money off of that bet? Are y'all paying him money when you do March Madness? What do you have to, have any of y'all entered that competition? Do you have to pay any money to do it? Is it just free? So I don't know. How did the prediction markets do on March Madness? Anybody get the Final Four? And the women's side was pretty easy, right? Women's side, you just pick the one seeds and you got it. And that's been true. The women's side is probably a little, I don't know if they do the March Madness on that. The one seeds do really well on the women's side because there's some dominant schools there. But the men's side, how many one seeds were on the men's side? Arizona? And anybody else one seeds? Michigan. So there's 2 out of 4, so not too bad. That's probably high. I think they've had some Final Four without any one seeds, right? So it's pretty hard to forecast, but from Buffett's standpoint, it's probably pretty safe bet. He'd be pretty right. Can you imagine someone being right until the final game and then losing that one? Wouldn't that be crushing? But just not likely to happen. You talk about, if you had a trillion to a trillion to the power of a trillion monkeys randomly typing, eventually one of them would type war and peace. I would say maybe, but if a monkey typed war and peace, I would still want to look and see if that was really a monkey or not I would still be somewhat skeptical. But yeah, it would be, to me, it'd be a monkey, 1 out of 1 trillion to 1 trillion power. It would get everything right until the very last letter, and then he would mess up and hit a C instead of a D or something. So, we're talking in games of chance, you have a lot more confidence, and that's why Warren Buffett is willing to put that out there. Now, he's had some other bets that were a little bit unfair. He bet hedge funds that the S&P would beat hedge funds. That's an unfair. You may know why that's an unfair bet. So, S&P beats hedge funds pretty regularly, but the reason that's an unfair bet is hedge funds hedge their risk. They tend to be lower risk than the S&P. They tend to be safer. That's just the nature of hedge funds. They're long short. They have a lot of risk covered. It's really hard when you're long short manager to beat the S&P. He should have done a bet of he could beat them on a risk adjusted basis. Then he'd be in trouble. Um, but he knows his math. Um, so avoid the big subjects that may hurt your future. Be fooled by small matters, not in the large. Demand certainty for a picnic. So avoid government social security forecast for the year 2040. This will get out of date as the book ages. I used to tease our actuary. I'm going to tell you all this, but I used to tease poor Asaph. I would say, your forecast on our pension plan, it looks really good, but in year 2070, are you really sure 6.3% are going to die? I thought it might be 6.2%. And he was like, yeah, stop bothering me around. I got a job to do. But it's like he gives me this year by year forecast of our pension plan. Who's going to die? Who's going to live? It's like, yeah, and he knows who knows what's going to happen. So forecasts induce risk taking. They're more toxic to us than any other form of human pollution. I don't know if I agree with that. But most of your firms are doing forecasting. You really should ask eventually. Once you've been there a few months, don't do it the first week. But why are we forecasting? They're going to say what? For decision making. All right. What was the last decision you made off of a forecast? We've actually never done that before. Okay, so why are you forecasting? Oh, for decision making? No. I don't know why we forecast. USA probably spends $3-4 million a year doing forecasting. I don't know why. I don't know what purpose it serves. It seems completely useless to me. And I was part of that process. It's like, why are we doing this? So anyway, your firms will do forecasting and no one knows why. Can y'all think of a good reason to do forecasting? I think it's for risk management, but most firms do a 1 point estimate forecast. What value is that to the firm? Can y'all come up with a good reason?
See possible outcomes just to have an idea of what could happen in the future.
But it's just one outcome though. So what's the probability that one outcome is going to be? Well, part of the issue I have with a forecast, if you have a 1 point forecast, not only do you have a 1 point forecast, you would hope that 1 point forecast would be your median, right? But we don't even know where it is on the distribution. So you have this forecast that could be skewed way to the right, skewed way to the left, but we don't even know. How can we figure out where the forecast is on the distribution? Well, we'd actually go back and look at our old forecast, but nobody does that because it's too embarrassing. I think they're useless. I actually think USA should shut down their forecasting and just stop doing it. What's the chances they're going to do that? No, because you're supposed to forecast. That's what accountants do. It's part of our job. It's like, okay, fine, you're going to do it, but it's kind of a waste of money in my opinion. But I have a forecast. I have my mom's plan. It's all forecast out. I'm just trying to figure out when her portfolio runs out of money, and then I'm responsible for paying her bills. But yeah, I'm not going to over rely on it. I'm just kind of getting a basic idea of how much longer the portfolio is going to last. I tell my brothers it looks like about 8 years, could be 5, could be 20. It kept extending the last couple of years because she kept making so much money in her, but now it's starting to take a hit. But I'm not going to over rely on that. So, all right, there's Taleb. He's depressing, right? So I started with Taleb. He's the most depressing one. He's your sobering person. He's a tough read. Actuaries don't like him because actuaries say we're a lot better than finance. So actuaries, I remember in one class, I had an actuary come and speak to the class, and they asked about Taleb, and he got really defensive. He's like, we're not like you finance people. We actually know what we're doing. So he got real defensive. I do agree, actuaries are better at this. They're much more honest in this. We saw an actuary speak to my P&C class on Monday. I love talking to actuaries because they were that kind of gene for Kirkpatrick of always giving you the downside. It could be this. We don't really know. Um, yeah, I mean, it's kind of, I forget what question I asked him. Um, oh, he was, how do you get a 1 in 500 year event on something that's almost never, how do you even know? And he's like, yeah, we don't, we're guessing. Yeah, I mean, they're pretty honest, very, very honest people, which I love. Finance, we tend to have a lot more cockiness and kind of display that we're a lot smarter than we really are. And it's just part of the business. So you're walking into a business that's pretty tough. That's why I say you add more value in finance through risk management than you do alpha generation side, because I just think risk is real where we're the least skilled at. And if we accept that the world's a lot riskier and we're willing to admit, I think you can add some value there. All right, no comments.
Oh, so if ever, let's say people stop chasing alpha and everything like that, and they all just focus on the risk management side. Do you think that would hurt the returns that are possible?
Well, there's the allocation efficiency of markets. So we need finance to do that. If more and more people go to indexing, it's going to make the opportunities for those who really know what they're doing more valuable. But we do need to allocate efficiency. We need to know that Circuit City is going to go out of business. Blockbuster is going to go out of business. We need finance to decide the winners and losers. I doubt we're going to get to the point. Right now, indexing is probably only about 30% of the market. So we still got 70% trying to win. Probably a good chunk of that 70% is just complete random noise. People are just maybe 40% retail. You do look at Renaissance Tech. It's hard to look at his numbers and not say James Simons hasn't figured something out. Those are, y'all seen his numbers? I mean, these are insane numbers, pretty consistent, but we don't know what he's doing because he's obviously not going to tell us. Are there some skilled people out there? I listen to Chris Asness. You should listen to him, read his papers. I think there's some intelligence there that gives him an advantage, but he's a risk manager. He's not an alpha generator. He understands if I manage risk. The advantage of being a risk manager is if markets fall 50% and they go up 50%, where are you? You start at $1,000, you lose 50%, where are you? 500. If you come up 50%, where are you? No, 750.
Yes.
So you're hurt much more on the downside than you're helped at the upside. If you're a really good risk manager, that's why a lot of people focus so much on low volatile stocks, because even though their average returns may be lower, when you adjust for that volatility, you actually come out ahead. And that may be one reason why low betas stocks outperform high beta stocks because of that. So there is some mathematical, and Cliff Asness, I'll read his stuff. That's why and the Motorin, the reason we started doing that PEG ratio strategy was because of the Motorin, and so far it's worked extremely well, probably just pure luck, but who knows. But that allocative efficiency is extremely important for capitalism. We need bad firms to go out of business and good firms to come in business, and the stock market does a good job on that. It is pretty amazing at times when we had the Challenger disaster. It is amazing. They took them several months to figure out who was at fault. When they figure out what firm was at fault, that was the firm that fell the most when the Challenger disaster happened. So the stock market somehow figured that out. So there's some smart people out there doing this, but there's probably a lot of people that it's just like going to Vegas and you're gambling. So I doubt we'll get to that point. The more and more people who get out of the business, it's going to create more opportunities for people leaving. I do think there's a good chance 5-10 years from now, it's going to almost all be AI, and there won't be individuals doing much. So who knows? Like, you have a question, Rich?
Yeah, kind of leading into that. So as more and more, data, sort of, as the years go on, right, data sets get larger and larger and larger just because more people, more information.
Yeah.
Right. Are there any false black swans that occur because experts forecast something everybody should?
I don't know, like a forecast cause black swan. I don't know. I worry about BlackRock. I wasn't my perception of BlackRock was this is a really sophisticated firm. I remember visiting them, and their mortgage-backed security expert was going to show me their model. And here I'm a CFA, I'm a finance person, I'm a smart person, I think. And he shows me the model and I go, I don't get it. So he explains it again. I was like, I'm not, explains it again. And he finally goes, to his assistant, you take this guy downstairs for milk and cookies. It was like, this guy is just not very smart. I didn't know what he was saying. And I've studied, I got USAA out of mortgage-backed securities, but he was so way over my head. So this is a really sophisticated firm. They had this software package a lot of people use, a massive part of the market uses. But then we had one of our alums go work for them, and he was working on that model, and it was not nearly as sophisticated as I thought. So I'm worried about that. When you have a lot of people using the same model, if there's some error in there, then yeah, you could see something like that happen. That's a little nerve-wracking to me. But who knows? Maybe BlackRock's not nearly as sophisticated as we thought. You're seeing Apollo and Blackstone is struggling right now on some decisions they've made. We'll talk about long-term capital management, very, very sophisticated firm, and they blew up for some seemed like pretty obvious reasons but there's a lot smarter people than I am, and they still messed up. So I don't know. I think it's possible. Um, just because too many people are leaning into the same trade. With long-term capital management, there's too many people leaning into the same trade and not knowing they were all in the same trade. And so when one had to get out, the whole thing just crumbled. But yeah, if y'all want secrets to how to manage this going forward, I don't have them. Other than be skeptical. Don't be cynical. If you're cynical, get out of the business. Become a middle school band director. But if you're skeptical, you're going to do a whole lot better. Never trust, and we're going to talk about this with Annie Duke. So I'll give you a little bit more positive spin here with Annie Duke. I do think she does give you some ideas on how you can do better. It's not perfect, but it's better. So any other questions on Taleb?
I had a question if you have time for it.
Yeah.
With the problem with forecasting, do you think that it's more efficient for certain firms, like matured firms or like telecommunication companies that are kind of like monopolized in their area to forecast? I feel like it's pretty efficient for them if they've kind of reached a capacity, making the decision of maybe going somewhere else if, subdivisions aren't being built, for example, or
Well, that's the risk management part of it. So if I were a business thinking, all right, should we expand to this market? First of all, you're looking to see having data. Who's in that market? Could we compete with them? What happens when we come in there? So you look at the upside and downside. Yeah, that's interesting. Energy firms can somewhat do this. They have some idea on the chances there's some good reserves there, like what they found in Guyana. That was massive. I forget, was it Exxon that found it? I forget, but so you can get some sense of that in some industries probably, but it's still, to me, it's a distribution. If we do this, what's the distribution? What's the upside versus what's the downside? Being as brutally honest as you possibly can. I would have thought Blockbuster was a pretty easy firm to forecast. And when were they going down? They're going down at the top. When they were doing their best, it was already writing on the wall. They were going under. So it's hard to say. Western Union, they're in the telegraph business, and this guy Bell comes up and says, "Hey, I have this telephone," or like, people aren't going to want to talk on a telephone. No, we don't want that. They had so much money invested in the telegraph, and it was just, so I don't know. Is there something you could do with forecasting to help a firm like that really well? With USAA, trying to forecast what autonomous vehicles can do with them. I don't know how you do that, but what if consumers just stop buying cars? That's going to destroy their auto insurance, which is a big part of their business. They're going to destroy their auto loans, a big part of their business. But what if you forecast that? What do you do with that information? When I presented to the risk management department, I said, well, maybe what you do is you call Tesla and say, we want to be your insurance company for autonomous vehicles. We want to strike a deal with you. Maybe you do that and you create a department of a few actuaries and finance people, and you say, hey, is there a way we can, it's kind of the black swan. It's like, if autonomous vehicles do take over and people aren't buying vehicles anymore, can we be the lead firm? I don't know. I doubt USA would be the best firm to do that. It's probably going to be a Chubb or a Travelers or somebody else. But yeah, so I don't know what you do with that information. You have it, but there may be some firms it's more valuable. But I still say do a distribution. Don't do a point estimate. Can you think of a firm that a point estimate forecast is really going to help them dramatically? We're just not very good. How far out do you go? I don't know. I can't think of I forecast my trips, but I do it in the range, so, where what's really going to hurt me the most. All right, let me give you some things you can do to try to get better at this. And this is what it's all about. My last couple of podcasts has been all about this decision making. That's what you're hired to do. You're not hired to do analysis, you're hired to make decisions. You need good analysis to do that. And so Annie Duke is going to tell you about how to improve the quality of this decisions. She's into this behavioral economics and finance. So that's all the Kahneman and Richard Thaler stuff. You should read those books. They're really, really good. Here's some other books you should read. Peak is a really good one. I don't think y'all have read this one. It's talking about how you get better at something that's in the golfing world or the chess world, those places where you can really hone in those skills. Range is where being a generalist triumphs. I love these two books because you read Peak, you got it, and it's going to work really well. And then you read Range, is like, yeah, but there's sometimes where that doesn't work. So it's really good. Peak is become a great golfer. Range, you become a good tennis player. They're different worlds, so you have to kind of figure out what world you're in, but they're both exceptional books. Have anyone read either one of these? So yeah, they're excellent, excellent books. This one's just amazing. There's some data in this book that are just phenomenal. I like deep work mainly because I think part of the problem we're having is we're so distracted. Cal Newport, if you don't want to read the book, go watch his TED Talk. He talks about this. He's pretty extreme. He shut down all social media. And his fellow professors were like, how are you publishing so much? And he just got much. This is a big risk for you guys. If you're going to be good at risk management, you can't be checking your phones every 3 seconds. You gotta shut it down. I have my phone on my bike rides for 4 hours, but I'm listening to books. I'm thinking. Sometimes I'll hear something in a book and I'll shut the book off and I'll just think about it for the next 45 minutes. Some of the math problems you get in my class, that was 2 hours on my bike ride. How could I actually show that? So, just deep work. You need to go out into the fields, lay down in the middle of a field with no social media and just think about risk for like 4 hours. Just let your mind get onto that. But Cal Newport talks about that. And Annie Duke, I really love her book, Making Smart Decisions. Behavioral finance is growing in importance. There are some people out there who think, Cliff Asness is a good example of someone who says, yeah, it's growing in importance, but I haven't figured out how to make money off of it yet. There are people who do think you can make money off of it, but it provides a better understanding of economics and how we actually behave as humans. What Kahneman and Tversky, what they showed is if you take the economic theories and you actually test them with live humans don't make decisions like that. We're not nearly as rational, but we're not irrational, but we're not as rational as these models. And where we're not rational, it's pretty materially different. So we're not as rational. So how can we use the findings of behavioral finance to make better decisions? And Annie Duke comes along and says, I got a solution. I'll get to it. She says, I'm a poker player. There's a lot of behavioral finance in poker. I'm going to take what I learned in poker and teach you how to become a better in this world.
How would that work with AI being more better into markets then?
Yeah, it's going to be interesting to see. So I think a lot of what I almost put it in the podcast today because we're talking about decision pods. I'm thinking make it to the point where AI becomes your decision pod, that you're actually talking to AI to be, you can tell AI be a devil's advocate, right? Argue the opposite side of what I'm arguing. And so it might get to the point where we're relying more and more on AI to get us to think outside and think more broadly. If you tell AI, we're too optimistic, we're not thinking wide enough on distributions, here's the decision I'm thinking about making, challenge it. I think AI is going to probably get pretty good at that. And that's part of Kahneman's. You really need to read Thinking Fast and Slow. It's an extremely important book. But we make decisions mainly thinking really fast. without really sinking into the distribution. We do that a lot, mainly because we just don't have time. So AI might be able to help us with that. Say, okay, AI, I'm about to make this decision. Do I need to slow down and say, whoa, 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 you need to think about this and this and this? Or it might hallucinate and give you completely horrible information. Michael Lewis, I'm not a Michael Lewis fan, but his book on Kahneman and diversity is actually pretty good. So I do recommend that one. Dr. Lowe talks about how to use this in a new way, thinking about adaptive markets. What he says is markets, you can't use history, the past to predict because the past changes the future. Markets adapt, they change. So how can you use his adaptive market hypothesis to make better decisions? They're all really good books. James Montier is one of those people who thinks you can make better investment decisions with behavioral finance. So he has this little book of behavioral finance investing. I'm not sure you're going to read it and become a radically different investor, but it will make you think a little different. And of course, Doug Hubbard is in there. I put Annie Duke in there twice for some reason, but so there's Annie Duke, professional poker player. She made $4 million in winnings. It's interesting hearing her talk about her big win, where she knew she was playing against someone that was better than she was, and she decided to play the distribution. She said, if I play the way I'm supposed to play, I'll probably lose. But if I take this 10% chance where, you know, I got a 10% chance of winning, 90% chance of losing, I'm much more likely to beat them doing that. And that's what she did. She took a radical position and ended up winning. Pretty interesting, right? She understood her distribution versus this. His distribution was to the right of her distribution. She decided to take the tail of her distribution. You kind of see where it's going, right? Go to the tail of distribution, which was to the right of his meeting. You know, so she's thinking statistically. Makes a lot of sense. She's a really good public speaker, good writer, at least on this book. She might have a third book out now. I haven't looked yet. So how is poker like life? You have a lot of decisions. It's a more compressed time frame in poker, but a lot of times your decisions in life are pretty compressed. It's got statistics. Yeah, you know the chances of getting 4 aces or whatever. It's got biases. There's reasoning errors. You can make mistakes. There's strategies that will make you better. There are people that are better at poker than other people. A lot of that's what life is like. Chess is not like that. Chess, the master always beats the novice. The loser in chess you can point out what mistake they made. You can go back. Poker, a novice can beat the master. The loser in poker can't always say what their error was. They might have done exactly what was right. The chances of that guy the only way he beats me is if he gets an ace, and the chance of getting an ace, I've been counting the cards, almost impossible. And what does the other guy get? He gets an ace. Was that a bad decision? No, it's a good decision. You made it statistically. That's not going to happen in chess. Poker players can make all the right decisions and still lose. You got bluffing. You got anticipation. Sometimes a novice will win because they're so erratic. It's like you're trying to figure out their bluff and all this, like, what are they doing? And that may actually end up being to their benefit. Thus, poker involves the human factor that you don't see in chess. I've never watched Texas Poker, that TV show. Any of y'all watch that? I can never get into that, but so what does it mean to think in bets? She says any decision about the future is a bet. You're becoming a finance major was a bet on the future of finance. You're going to UTSA is a bet on UTSA versus Harvard or Yale or Stanford. You're making a decision, it's a bet about the future. You're unfortunate for you is you don't know what the other paths would have led to. There's possibly one path in your life where you're worth $10 billion. There's one path in your life where you're living on the streets. Who knows? You know, out of a billion paths, who knows? So you're never going to know if you made the right bet. But every decision you make in life is a bet. We can treat all decisions as a bet, given that all decisions involve some level of uncertainty. There is often a weak connection between the quality of the decisions and outcomes. This is really key to what she's saying, because how do we grade our decisions? We grade them based on outcomes. She says that's wrong. You don't base your decisions based on outcomes. You don't measure the quality of the decision based on the outcomes. You measure it based on the information you had at the time you made the decision. If you base it on outcomes, you're letting a lot of random chance influence your assessment, and that's wrong. Luck plays a huge role in the outcomes in both poker and life. We tend to say when we have good outcomes, that was a good decision. We tend to, when we have bad outcomes, we say that was bad luck because we want to protect our egos. Say it works out. Yeah, I knew it was going to happen. Yeah, I saw that. You bet on a team and they win. And say, yeah, I knew they're a quarterback. Yeah, I mean, you can just tell, right? We get all this cockiness. We'd say stuff we weren't talking about beforehand. Our teams lose. Yeah, I was just unlucky. Who knew that, they had that fumble at the end. Who knew that was going to happen? And then with the other people would do the exact opposite. When other people do well, say, yeah, they were just lucky. When things don't work out, yeah, you could see that coming, man. They don't know what they're doing. So you can see how that intuition and relying on our experience, how bad that is, because our egos are going to make us remember things so badly. So we rationalize our decisions to make us look better, make other people look worse. So here's what we're going to go with Annie Duke. I really like Annie Duke. So we're trying to distinguish between decision quality. We're really after decision quality, which means there's sometimes things work out well and we were lucky and that's going to hurt our ego. We're going to have to admit, that wasn't a good decision, but boy, am I glad it worked out. And there's other times you're going to give yourself some compassion where it didn't work out. You're going to say it was bad luck. And there's sometimes where it didn't work out and it was because of a bad decision. So you're going to have to try to figure those out. All right, so we'll start there next class.